Hour, we're going to talk to the CEO of nuclear technology company Oklo, whose shares are jumping again today. They've climbed more than 75% just in the past month after a deal with the Air Force and a $400 million capital raise. Plus, an AI feud spills out into the open as Microsoft and OpenAI reportedly spar over the future of their game-changing partnership. New details ahead.
First, though, let's get some breaking economic data just crossing the tape and get to Rick Santelli. Good morning, Rick.
Yes, good morning, Carl. April business inventories expected to be unchanged, arrived exactly as expected, unchanged. And here's what's fascinating. If you look at January, up 0.4. You look at February, up 0.2. You look at last month, up 1/10, now unchanged. And this is the first month of the second quarter, and we see that the inventory build is coming the other way because of pulling forward. So it does make sense, and, of course, this number at 0 isn't going to really contribute much to GDP, although we have seen some other inventory numbers that might. And in addition to this inventory number, we also have National Association of Home Builders Housing Market Index for June. And for that, we head east to Diana Olick. Diana?
Well, Rick, home builder sentiment in June dropped 2 points from May to 32 on the NAHB index. The street was actually looking for a slight improvement. This index has only seen a lower reading twice since the Great Recession back in 2012, and that was in December of 2022 when mortgage rates first shot up from those pandemic record lows, and in April 2020 at the very start of the pandemic. Now, the builders cite high mortgage rates, tariffs, and overall economic uncertainty. Of the index's 3 components, current sales conditions fell 2 points to 35. Sales expectations in the next 6 months dropped 2 points to 40. And buyer traffic fell 2 points to 21. That is the lowest reading on that since the end of 2023. As a result, builders are cutting prices. 37% in the June survey said they did. That's the highest share since NAHB started tracking this 3 years ago. It's up from 34% in May and 29% in April. The average price reduction, 5%. NAHB's chief economist, Rob Dietz, said given current market conditions, NAHB is forecasting a decline in single-family starts for 2025. Regionally, on a 3-month moving average, the South and West were the weakest. And of course, that is, Sarah, where we build the most homes, usually.
I wonder how you put that up against what we got from Lennar today, the home builder, which, as I mentioned, has actually been a winner, even though some of it was soft and they talked about the challenges in the market, like affordability.
Yeah, exactly. But they also lowered prices. You saw the average home price on closings down nearly 9% for Lennar, and that's what we're seeing from the builders as well, as cutting prices, and begs the questions, are they even able to buy down those mortgage rates? Ivy Zellman said last Friday on our air that even when you buy down those rates, a lot of consumers still can't even qualify at the lower rates. So Lennar is seeing that weakness in demand because of affordability.
Okay, thank you, Diana. Diana Olick. Speaking of overall demand, wanted to dive into retail sales a little bit. This is the month for May, and it paints a picture of a softening consumer. The overall headline number slipped 0.9%. That was worse than expected, versus 0.1% the month before. If you look and break it down, you can see it was pretty much lower across the board. Here is what the May number looks like relative to the April number. So total retail sales were lower. If you take out autos, it was also lower. But autos, you can see, was a big drag. We did see a big dip in the month of May for auto sales. And then general merchandise, they're, slightly higher to unchanged. If you break it down a little bit further to see what the biggest losers were on the month in terms of declines of retail sales, gas stations, autos, food services, and drinking places. I highlight this one because this is the only services part of the overall retail sales number, and it saw a decline. And that's important because it speaks to the softening momentum in the U.S. consumer. Services had been a really strong part of the economy, and so has, restaurant services. So that would decline. Grocery stores were also down. There were some offsets. Miscellaneous store retailers, that could be anything from pet stores to used merchandise. That was strong. Sporting goods, hobby stores, furniture had a little bit of a comeback. Online, still positive, and surprisingly, clothing positive, but not enough to offset the overall number, which was down. The only silver lining here, guys, is that the control group, which actually feeds into our overall GDP, was quite strong, and that's going to make GDP second quarter look a little bit better thanks to the rise in furniture and sporting goods and that sort of thing. So kind of a mixed picture there. But David, as I mentioned earlier, the Fed tomorrow has a tricky job when it comes to characterizing what it's going to do next and what they think about the economy, because you cannot deny there are signs of softness from retail sales to the Fed beige book to some of the employment numbers.
Any new words we think that Chair Powell will use? You want to take an over-under on what they might be and therefore how often they'll be
uncertainty.
Mentioned? We're going to hear that one, right?
Uncertain is going to be a big one,
Yeah.
whether it relates to business, consumer uncertainty, but also the Fed uncertainty. Because here's the thing, that their dual mandate is pointing them in different directions, and they need to decide which one they're more worried about, weakening economy or higher inflation. And if they are truly data dependent, right now it is weakening economy winning out over inflation. So if they're going to say they're worried about inflation, they have to make the case of why they think the tariffs are going to cause inflation, because we just don't see that yet.
Well, do you imagine the Q2 GDP will be a reversal of Q1?
For sure.
So why wouldn't the Fed say the same thing about the inflation data they're getting right now?
It's what the same thing that they said about Q1, which is it's totally distorted by imports and exports, and there's a lot of a give back.
Well, that's
on
the
that
problem
front.
with being data dependent, is that there's
on
huge
GDP,
distortions.
It's the problem with GDP dependent. But I think if you look at look, they could easily make the case that the economy is doing fine. The unemployment rate is 4.2%. It barely budged. But they could also make the case that the economy is showing some signs of softness, and I think that's what the market is telling you when it says that we still could see almost 2 rate cuts.
Yeah.
This year.
They've cut 100 basis points. We're still waiting for all that to filter in.
Yeah, I think the question is just how, I spoke recently to Governor Kugler. She gets
She's
a vote every
hawkish.
time, very hawkish, and she's very worried about inflation, even though we just haven't seen signs. She's looking at some of the surveys about companies saying that they're going to raise prices or consumers expecting higher prices, and that's going to be the big debate. How much do you read into that kind of stuff? Because long-term inflation expectations, 5-year, 10-year, they're not showing any big concern there.
Well, yeah, unless on UMich, they're still pretty elevated on a...
But that's survey stuff. Yeah, sure. But that's also very partisan.
Yes.
I mean, look at the breakdown of Democrats and Republicans, and they cannot make their policy for Democrats that are expecting a big inflationary wave as a result of tariffs.
Right. Meantime, stocks are under some pressure today this morning as investors watch developments out of Israel and Iran, and of course that week retail sales number. Joining us this morning, Fidelity Investments Director of Global Macro, Urian Timmer's with us, who I'm sure has been listening in. Urian, it's good to see you. Of the dual threats that we were just discussing, do you think that one is more pronounced than the other?
I think they're fairly in balance right now, and again, this is really the first time in decades that the Fed has had to really think about both mandates, right? And for the last 15 years or so, whenever there was a shock to growth, inflation was below the Fed's target, and it could just really go asymmetrically down towards zero and do QE. I think those days are over. The way I think about it, if a neutral rate is inflation plus 100 basis points, and let's say inflation's 2.5 right now, maybe 2.5 to 3. You got 3.5 to 4. The Fed's at 4 3/8, so it could cut twice and be right at neutral. And I don't really think there's a need for it to be below neutral. But I think the bigger story actually is so I think the Fed probably does nothing, but it certainly has room to cut a couple of times. But I think the bigger story is that what the Fed does just is less important than it used to be, right? What happens at the long end of the curve, which the Fed doesn't directly control, is far more important. So if the bond market concluded that the Fed's cut, if that's what it does, is premature or ill-founded, the curve could bear steepen, and that would be an even bigger problem. And so not many institutions or people borrow at the short rate. I mean, banks fund themselves at 0.5% on their deposit rate, so they have a very steep yield curve already. So I don't think it really matters. What happens to the long end at 444 is much more important, because nothing good happens above 4.5%.
Right. But do you think vigilantes would revolt on a single cut tomorrow?
I don't think they would. But if the Fed the Fed learned from the late 60s, not to dial back the clock that long. It pivoted in response to a slowdown, and it took its eye off the ball, and the fiscal impulse was going very strong at that time, late 60s, guns and butter. And it had to take those cuts back and then tighten because the inflation genie was getting out of the bottle. And so I think the Fed has an eye on the fiscal side of the house. My guess is that it underestimated that in 2021, which is why they overstayed their welcome and didn't take that punch bowl away as the party got started. They wait till everyone was passed out. My guess is that that is also a factor here, that they want to lean into that a little bit more so that that inflation genie doesn't come out of the bottle.
Oil, WTI at 72, Brent's at 75. So we're looking at elevated prices from where they were, but I guess relative to history, maybe not so much given what's happening geopolitically. When does it become a story that matters for the economic outlook, the inflation outlook, and changes the narrative?
Well, the Fed generally looks at core inflation, right? So you take out the things that we actually spend money on, and inflation is running at 2.5, 2.6 on the core PCE. So if there was a perceived
We're going to talk to the CEO of nuclear technology company Oklo, who shares our
would look through that. Although oil prices do directly affect the tips market, so it could actually affect the intermediate side of the yield curve. But my sense is that the Fed looks beyond that. For me, the bigger issue is that, pre-COVID inflation was at 2. During COVID, it went, or after COVID, it went to 9. Now it's at 2.5. But it never really crossed below 2, and it needs to do that in order for the average, the 5-year average, to be back at 2. And the 5-year average is at 4 and rising. And so just because inflation's down to 2.5 doesn't mean that the battle has been won. And I think the Fed acknowledges that, and certainly rising oil prices wouldn't help. But I do think that unless it's a lasting impact, the Fed would look through that.
Finally, Urian, on the dots, our friend David Rosenberg this morning writes some advice for the Fed. Ditch the dots, essentially arguing that's what a lot of corporates did when it came to corporate guidance. Do you think they mean anything tomorrow?
They mean less than they used to. The Fed is data dependent. I mean, it always is, of course. But in a data dependent mode, the dots really are subject to change, just like the forward curve is, and the forward curve is always changing. The dots were created after the financial crisis, and it was really a tool to create forward guidance at the zero lower bound. In other words, you tell everyone we're not going to raise rates for a long time. At 4 3/8%, the dots kind of have lost their purpose in some ways. So I don't think they really matter a lot. And a real-time version of the dots is the forward curve, the SOFR curve, as we call it. But looking at where the dots are relative to where the forward curve are does tell us whether the market and the Fed are in agreement. And they actually are more or less in agreement right now, and they have been for the last year or so.
Right. That's a good curtain raiser as we await tomorrow's decision and remarks. Urian, talk again soon. Thanks. Urian Timmer.
I've been bashing the dots for a while. They're hard. They're tricky. Here's our roadmap for the rest of the hour. Oklo powers up, the nuclear name surging in recent days on an Air Force deal and a capital raise. We're going to talk to the CEO about the push higher.
Plus, a potential AI battle out in the open. Microsoft and OpenAI reportedly are fighting over the future of their partnership. We're going to talk a bit about what that fallout could mean for OpenAI. And
the outlook for solar getting a little cloudy today. Sectors plunging, worst day in several months as the Senate looks to cut some incentives on clean energy from that bill. More those stories and a lot more when Squawk on the Street continues.
5100.
Welcome back. Stocks pairing some early losses, now down just fractionally for the major averages. Meantime, President Trump is back in Washington after leaving the G7 summit early as tensions escalate in the Middle East. Joining us now is Aaron David Miller, Carnegie Endowment for International Peace Senior Fellow and former Arab-Israeli negotiator, also has a book on America's elusive search for Arab-Israeli peace. It's good to have you. What do you think the U.S. does? Do you think it ultimately enters in some military form?
Look, I think the president confronts a dilemma, as do the Israelis and the Iranians. He does not want to enter this war. It's got too many uncertain consequences, but at the same time, he can't end it. And in a way, he's in a box. And I think what you see reflected in his statements and his actions, including the 11th hour departure from Calgary last night, highly orchestrated, urging all Iranians to leave Tehran. He still doesn't want to go to war, so they're trying to come up with a diplomatic off-ramp, maybe using the vice president and his friend Stephen Witkoff. Hard to imagine, though, while Israeli attacks continue, and while the Iranians don't want to give in, that diplomatic off-ramp is going to be anything other than a key to an empty room.
I mean, the president has been very consistent on Iran. They cannot have a nuclear weapon. So is Israel able to achieve that, I guess, is one question, without the U.S., or is it just inevitable that the U.S. enters?
You know, Sarah, the last four presidents have also made it unmistakably clear, repeatedly clear, consistently clear that Iran cannot have a nuclear weapon.
They failed.
Right. And frankly, as a consequence of Mr. Trump's decision in 2018 to withdraw from a flawed but highly functional agreement which restrained and constrained Iran's pretensions to get a weapon, the Iranians are now closer than ever. So you now have a crisis without an opportunity. Yeah, we could go in using the bunker busters, the GBU-57 bombs carried only by B-2 Spirit bombers, 20,000-pound bombs, 20 feet long, drop 6 or 7 of those on the main enrichment facility at Fordo, and you could probably destroy it. The problem, of course, is how does that end the program? Without occupying Iran and literally forcing some sort of regime change, which would be a disaster, it seems to me, you're now faced with neither a black or white solution. So you have three options here. Number one, the Israelis continue to do what they're doing without destroying the program. Second, against all odds, you end up with some kind of diplomatic off-ramp. Or third, the administration basically succumbs to Israeli pressures to basically enter the war, and that will deal the program a considerable, perhaps even a fatal blow for now. But again, oil's going to go over $100 a barrel. You're going to end up with Iranian strikes against American forces and likely against Saudi infrastructure. And again, where is the end state here? That's the problem, both with Israel's policies and ours.
Meantime, the question will be how much infrastructure is vulnerable in the meantime. Journal's got a piece up right now saying the two oil tankers collided in the Gulf of Oman, not because of any issues with the straits being blocked, but just because so many transmissions are being jammed by both sides in this conflict. That's troublesome for oil, or it might be.
I mean, it's a critical point. Without closing the Straits of Hormuz, which the U.S. would open at some cost, the Iranians have all sorts of asymmetrical policies to pursue to create confusion. Look at the Red Sea. Look what the Houthis have done. They basically have forced international shipping to raise its costs, and instead of going through Suez, which has cost the Egyptians hundreds of millions of dollars in toll revenues, they've got to go around the Cape of Good Hope, which adds another 3 weeks to those trips, jacks up insurance rates, and increases the cost of consumer goods. So again, Iran should not have a nuclear weapon. This is a terrible regime. It it prosecutes, imprisons, tortures its citizens, but there are no good responses here. And that's the dilemma for this administration. And I worked for half a dozen Republicans and Democrats. It's been their dilemma as well.
Israel's been fairly open about what its goals are, though, which is to destroy the nuclear capability and also the missiles, which Iran is using against an Israeli population, civilian population right now. And Trump has been pretty clear about the goals as well. I think one other piece of it, David, as you talk about what David, as you talk about the upshot and where this goes, is that that Prime Minister Netanyahu has been calling on the Iranian people, as their regime has been weakened, to rise up.
It's a good point, Sarah. But again, and would I like to see the Iranian regime change? Absolutely. It's autocratic. It's extractive. The Iranian public has been suffering. They want more openness, more connection to the world. But regime change in the Middle East, at least in recent years, occurs only under one of two circumstances. In the case of Egypt and Tunisia, you get hundreds of thousands, millions of people out in the streets, which forces the military into the situation of whether they're going to fire on their publics, or in the case of Mubarak and Ben Ali, they lost power. Or in the recent case of Syria, you have a well-organized, formerly affiliated group with Al-Qaeda, Hayat Tahrir al-Sham, HTS, backed by the Turks, a coherent, cohesive group with military capability. It moves on the capital, on Damascus, and within 3 weeks, the Assads are gone. I don't see either of those scenarios relevant, frankly, right now to Iran. And look, one more point on the Israelis. They have a legitimate existential problem with the Iranians. There's no question about it. But look at the last 18 months. The most capable, competent, determined military in the world, probably, given scale, obviously, is a constraint, has spent the last 18 months, according to the Prime Minister's calculation, trying to achieve total victory in Gaza. You have 55 hostages, half of whom are alive, half of whom are dead, still suffering. Hamas, which has been hollowed out as a military organization, still is the most important influential Palestinian actor in an area roughly twice the size of the District of Columbia. So I have to say, watching the Middle East, helping U.S. policymakers for 27 years, it's a complicated place, and it really rarely produces Hollywood endings or either black or white solutions. And I fear on this one, we're going to have to live in the gray zone for some time to come.
Okay, Aaron, David, thank you very much. Pleasure having you on with your perspective.
Thanks for having me.
When we come back this morning, we mentioned solar stocks getting hurt today as some new details emerge on the Senate's changes to that Republican bill. We'll talk about what lawmakers are proposing next. Later on, we're going to be joined by the CEO of nuclear power company Oklo as shares hover inches from some new all-time highs. As we've erased some early losses here, Dow's down 40. Back in a moment.
theaters July 2nd.
Welcome back. We're now 30 minutes into the hour. Here are three big movers we're watching. Shares of JetBlue are sinking after the company said it was looking to cut more flights and reduce costs on softer than expected travel demand. Stock down 3.5%. Eli Lilly announcing plans to buy gene editing company Verve Therapeutics, paying about $1 billion up front, with another $300 million contingent on Verve achieving certain clinical milestones. And then we mentioned solar stocks. They are absolutely plummeting 20, 30, 40% after a Senate panel proposed a full phase out of solar and wind energy tax credits by 2028 as part of changes suggested to President Donald Trump's sweeping big, beautiful bill. And with that, let's get to Emily Wilkins in Washington with the latest, Emily, on the Senate version of the bill, what's in it and how folks are reacting.
Hey, Sarah. Well, at this point, the reaction hasn't been all positive. I mean, the Senate version of this multi-trillion tax bill, it just dropped yesterday, and it is already in trouble with both House and Senate Republicans raising concerns about some of the provisions. Some, like Senator Josh Hawley, he's concerned with some of the cuts to Medicaid that are in the bill, specifically limiting that provider tax that states can charge to health care providers. The Senate is much stricter than the House on that. Others are concerned about the overall cost, and that includes Senator Ron Johnson, who said this morning on CNBC that more spending cuts are going to be needed.
They talked about the only numbers that count are 218 and 51. Again, that's not the type of goal setting we need when we're $37 trillion in debt on the road.
The Senate measure makes dozens of tweaks to the House bill, and that includes making key tax breaks for businesses permanent, including on measures like research and experimenting, faster depreciation, and deducting interest. It also slows down the phase out of clean energy tax credits compared to what was in the House bill. So things are a little bit better for solar and wind, although not as good as it would have been before these policies were proposed. And the Senate bill also would blunt the impact of that so-called revenge tax on foreign countries and investors, giving countries more time to potentially negotiate something with the U.S. Now, the text that Senate Republicans leased did not contain a final proposal for that state and local deduction cap. Senators have said, though, it will be lower than that $40,000 proposed by the House, and that has provoked a group of Republican House members from high-tax states to threaten to sink the Senate bill if it even goes $1 under that agreed-upon $40,000 cap. Congress is going to need to move quickly if they want to finish this by July 4th. And Sarah will be keeping a very close eye on what the next steps are going to be and how senators react when they meet today.
Emily, thank you. Emily Wilkins in D.C. Let's get a news update now. Courtney Reagan has that for us. Courtney.
Hi, good morning, David. A Russian missile and drone attack on Ukraine killed at least 15 people overnight, according to local officials. They say more than 150 were injured in the bombardment, which heavily damaged a 9-story apartment building in Kyiv. It is the deadliest attack on the Ukrainian capital this year. Former Senator Bob Menendez surrendered himself today to a federal prison in Pennsylvania to serve 11 years on bribery charges. A jury found the New Jersey Democrat guilty in July of taking part in a scheme that awarded him and his wife, Nadine Menendez, hundreds of thousands of dollars in gold bars and cash in exchange for his influence. His wife was convicted in a separate trial and will be sentenced in September. Kraft Heinz announced today it will remove artificial dyes from its products by the end of 2027. The decision comes as the FDA and Health and Human Services Chief Robert F. Kennedy pushed the food industry to drop the dyes. According to Kraft Heinz, about 10% of its products use the ingredients, including Crystal Light, Jell-O, and Kool-Aid. Sarah, I know you were talking about this earlier. What color is Kool-Aid going to be now? Back over to you.
Yeah, or Jell-O. It's going to be clear?
I don't know. Strange.
Maybe they'll use like real strawberries. Thank you, Courtney.
Thanks.
Courtney Reagan. The Federal Reserve meeting getting underway today, and there are some hopeful signs for the bulls in CNBC's latest Fed survey. We'll share the details after this. Plus, uranium prices spiking this week as hopes around nuclear energy and energy independence grow. We're going to talk about the stocks to watch in that space later this hour.
Pumpkin.care.
Welcome back. Fed meetings getting underway today, and some growing optimism, perhaps, among CNBC's Fed survey participants about the outlook for markets. Steve Leisman has the details for us. Steve?
Yeah, David, a little bit brighter when it comes to the outlook for stocks, with respondents to the CNBC Fed survey lowering their recession probability and seeing more of a bounce back in the economy and stocks in 2026. Year end, we're looking at 61.33. That's just up 1.5. But things look better for 2026. 66.25 on the S&P. That's up nearly 10% from yesterday's close. Hank Smith of Haverford Trust writes in with the survey. Equity markets are near all-time highs in anticipation of certainty replacing uncertainty on tariffs, the 2017 tax cuts getting extended, deregulation, AI productivity, and Fed easing. If all this occurs, the economy should reaccelerate in the second half into 26. 10 years seen a bit higher at 443, up from the prior survey, but below the current rate, and also a little bit better, but still higher in 2026 relative to the prior survey. On the tax bill, 43% believe it will significantly increase the deficit, 39% somewhat increase, call it 82% think that this tax bill will indeed increase the deficit. And respondents, our 28 respondents, are divided when it comes to the outlook for the tax bill when it comes to growth. 29% say it will, they're more optimistic on growth, 29% say less optimistic, 43% say it doesn't matter. Here's the outlook for the Fed. 100%, no change for this week, and 100% next week. Not 100%, but no expectation for a rate cut next month. But 38% is the recession probability. That's down a bit. And you can see there are 2 cuts built in for this year, just 1 for next year, with the funds rate remaining above the long-run neutral rate into 2026. Bottom line, outlook is a bit brighter than it was in May, but still depressed from January. There's a growing sense the economy absorbs all these changes and finds its footing in 2026. Guys?
So is the view that the Fed should look through the tariff inflation or not?
So, yes, if the tariff inflation can be looked through. Sarah, I'm sorry to throw it back at you. That's really what it amounts to. I will say, by a 4 to 3 margin, they do think the tariffs end up being one-time price increases. 43% to 32% think it creates a broader inflation. If the 43% are right, then the Fed can and will look through it. It ends up creating a broader inflation problem. I will say this, Sarah, 61% do say that tariff inflation is yet to come in the months ahead. They don't think that what we've seen the last month or so is indicative of what's going to happen from price increases from tariffs.
Yeah, we will have to, we'll have to wait and see. Steve, thanks. Talk soon. Steve Leisman, busy week. After the break, Oklo's power surge. That stock has more than tripled on the year, up triple digits this quarter, hitting some all-time highs in the last week. CEO is going to join us next with what's driving that jump. Tensions reportedly running high between partners OpenAI and Microsoft. Talk about that possible fallout later on this hour. Uranium spot prices touching their highest levels of the year. Expectations growing now around the nuclear energy industry. Our Pippa Stevens joins us with a look at those moves from solar to uranium. Busy week, Pippa.
That's right, Carl. So uranium stocks are starting the week off with a bang after the Sprott Physical Uranium Trust raised $200 million in an upsized offering to buy physical uranium in the spot market. That sent spot prices to $76 per pound, a price not seen since December, according to UXC, and led to a rally in mining stocks on expectations the purchase will make market fundamentals tight. Denison, Paladin, and Boss Energy all up double digits on the week so far, with Cameco, the world's second largest producer, also higher. Now, nuclear also a surprising winner from the Senate's version of the tax bill, with the full credit given to projects that begin construction by the end of 2033 and a step down through 2035. And that, of course, follows President Trump's executive orders aimed at boosting the industry and quadrupling U.S. nuclear capacity by 2050. David?
Pippa, thank you. We're going to have a lot more on the nuclear industry after the break. We're going to be joined by the CEO of Oklo. Plus, we'll also talk a bit about some of the growing feud between Microsoft and OpenAI, what it centers on and what it could mean, of course, for the future of OpenAI as well. We'll be right back.
Pumpkin.care.
We're taking a look at, ooh, I like that. Is that new? Shares of Microsoft are a bit lower. Unclear whether, in fact, that's due to this latest story in the Wall Street Journal. Sort of details, well, I guess what would have to be considered increasing tension between the two parties who have been partners for, of course, quite some time. Microsoft providing so much of the initial capital that allowed for the compute that allowed OpenAI to create and get ChatGPT going. But there's a lot of growing tension between the two that is detailed in the Journal story. We talked a bit about it earlier, Sarah, but I've been able to do a bit of reporting since then, and apparently a number of the hot buttons, they're not necessarily about, as it transitions to this public benefit corporation, what's Microsoft's ownership going to be? That's certainly not unimportant, but hot buttons are more about who gets which IP when and the exclusivity to it. And that, of course, was an important part of their agreement as well. Microsoft obviously granted that exclusivity. But things about coding or products or when they reach, if they ever do, so-called API. What can you use and when? What does Microsoft get? What don't they? What is ChatGPT going to be able to bring to the market without having to worry about Microsoft? That certainly is something they're trying to work through right now, is my understanding. And it's not easy. Not easy, as you might expect.
Is there a possibility they could break up?
I haven't heard that, but it's certainly they're certainly moving further apart. And if they do succeed in this capital restructuring, that'll be another sort of move potentially apart. But the hope is they can resolve where things stand in terms of the IP and who has the exclusivity and when. But they are still in the midst, of course, of creating that new capital stack, so to speak, as we say, as they potentially transition to this public benefit corporation, which will have an impact on existing shareholders and on Microsoft and SoftBank as well. The money that went in there is dependent upon it to a certain extent in terms of how it's treated in the capital structure. So no shortage of complexity here.
It sounds messy.
Yeah.
Let's turn, speaking of AI, to Oklo. It's been an AI winner, approaching record highs, up around 80% in the past month. It's a nuclear company which just secured a deal to supply power to a U.S. Air Force base and raised also recently $400 million in new share offering. Oklo CEO Jacob DeWitt joins us now. It's good to have you back. Jacob, welcome.
Thanks for having me back.
I guess we should start with that deal, because huge gain for your stock on the back of the Air Force. You're going to power this Air Force in Alaska. What does it look like in terms of longevity and potential for recurring revenue?
Yeah, it's one of the exciting opportunities we saw with sort of being able to partner with the government and the defense side to provide resilient, kind of durable power solutions. It's one of the things, especially as we see different defense installations and capabilities moving to needing more and more, power, as well as, by the way, heat and steam, because that's an important feature to have up in a place like Alaska to keep things working in the winter. It's a pretty neat opportunity for what nuclear can do very well. So looking at this as a multi-decade kind of time frame, stretching out 20 to 30 years, some of the details, of course, are going to be finalized as we get closer to actually building it. But yeah, very exciting opportunity and a very important part of sort of helping serve to the national interest.
I mean, a big vote of confidence in your company. What are there further negotiations about doing this at a broader scale with the government?
Yeah, I mean, it's a great question. We were excited to be selected kind of in a smaller group of folks, also in addition to what we just won with the Air Force in Addison, as part of something called the Defense Innovation Unit and their advanced nuclear program over there, which could open the door for a significant number of additional bases as well. So, when you combine those aspects and then touch on sort of what there's a policy push, right, coming from the government right now, looking at ways to use defense infrastructure and land and perhaps power that can be generated, like by us, for example, on the bases, to also power data center capabilities and AI capabilities on defense installations. It's a pretty exciting space to think about what the trajectory can look like going forward. But yeah, we were very excited to get that as a big win for us last week.
I mean, clearly the trajectory is exciting for investors. Question is, when will we actually start to see you be able to stand it up?
I think this is one of the things that's really exciting right now is on the backs of the executive orders a few weeks ago. Couple that with the broader macro environment here for nuclear and for energy as a whole. There's things that can actually do something that people don't talk about a lot, which is move schedules to the left, not to the right. So we're eagerly, executing against looking at different accelerated timelines and pathways. The key things are, though, sometimes people think nuclear is out in the 2030s and beyond. It doesn't have to be, and it isn't. For us, we have a site, we have fuel, we've been making steady progress for a long time. We've been at this for 12 years. So we're excited about having a good, clear trajectory of a first plant online in Idaho, late 27, early 28 is a target, with additional plants coming on after that, especially given that we're looking at regulatory accelerations as part of sort of what's happened on a bipartisan policy basis, as well as from this administration. and making fuel more available, which is one of the biggest bottlenecks we have to scale beyond sort of 1 to 3 to 5 to many. So that's now something that's being fixed through these executive orders as well to kind of bridge us into a commercial fuel supply chain. It's going to be accelerating the timelines here to be faster. Now, not all companies are going to move at those same paces, and that's what's a feature in the system right now, right? We have a lot of innovation, a lot of new approaches, and we're just excited to be kind of at the forefront we're on.
Right. So you sound pretty confident you're going to get stuff up and running, as again, to use your words, by 27, 28, and 29. So because we've all been working with sort of that 2030 or 5 to 7 year timeline for so many of these small modular reactors. That's not going to be the case here, Jake, is what I hear you saying.
Right. Not at all. Right. We have a site use permit we got back in 2019. We got fuel back in 2019. We're working on actually developing that site and getting, breaking ground, targeting at that. Actually, we're really working towards getting that done later this year to be able to then, have this plant being built, get the permitting in place, and then load it with fuel and start it up. We have all the right pieces to do there. It's really execution now. And obviously, with the capital raise we just did last week, gives us more fuel to accelerate those things, especially on the backs of those tailwinds. And the big thing about the tailwinds of those EOs, the big thing about those too is it's really accelerative, not just to go to the first plant, but to your second and your fourth and your fifth, so on and so forth. So those are the things we're now kind of leaning into and doubling down on.
Yeah. Well, now, tell me about, you're kind of becoming vertically integrated too, right? I mean, radioisotope production is also an important component now of your company. I know you're doing things there as well, I believe, in Idaho, and you're recycling. What is the, what is the goal there, and what are the production opportunities and timelines?
Yeah, I mean, this is the beautiful thing about nuclear, right? It's incredibly energy dense and abundant. And so the thing is, though, with current sort of approaches on fuel technology, we only use about 5 to 10% of the fuel, which means waste is like 90 to 95% unused fuel. And with fast reactors and advanced recycling techniques that have been developed and pioneered at the national laboratories who we're partnered with, you can actually tap into the rest of that fuel and turn, what's effectively a waste into, or a liability, into a strong asset. And along the way, you open the door to do some cool things. What nuclear waste also has is this treasure trove of radioisotopes in it that have significant applications in defense purposes and medical purposes, even actually things you can do to support semiconductor fabrication. So we're pretty excited about being able to, that's why we made the acquisition of being able to partner up with this company that has state-of-the-art radioisotope production capabilities and recovery capabilities to then bring that capacity forward into the market. The unit economics of that are very interesting and very attractive, and was a natural kind of bolt on to what we're doing on the business as a whole. So we're excited about what this does in terms of opening up alternative pathways for sort of revenue generation, as well as accelerating aspects to it, because there are things you can do in that space before we'll be turning our reactors online. And so that's another part of why we, pursued the capital raise we did last week, is to accelerate into that.
Right.
Best case, how much incremental revenue could you be talking on some of those other lines?
It kind of depends a little bit on when some of these things are going to come into place and what the source of some of the fees are. So how about we come back and visit you guys maybe a little bit later? We'll have a clear answer on that.
Yeah, we're gonna make sure of that. As for, you talk about moving schedules to the left, what are the natural tensions that prevent it from moving farther to the left? Is it mostly about materials, or is it labor, or is it some element of administration?
Yeah, I mean, there's really three major pieces. There's the supply chain and the components you have to buy and build and do all of that. That's something you can shrink down to a degree, but really at the end of the day, it's about an 18-month lead, kind of as the longest pole in the tent. Then there's fuel. We have fuel, but we have to fabricate it. So that's why we've been making progress to build out fuel fabrication capabilities at Idaho National Laboratory at a pilot scale. That's going to be operational here, producing fuel next year for us. And then it's the permitting side. And with the recent executive orders driving towards an 18-month timeline, which is better than, before those, we were looking at a 24, 25-month timeline. Hey, we're in a great spot now to see significant accelerations of lining up on kind of these 18-month cadences. So the moment is ours. I mean, it's really not possible to do much before, like in terms of meaningful power, until before 2027. And that's even aggressive. But hey, all the things are in place for us to go do that. And we have the right sort of structure, framework, and the right time under our belt. We've been at this for a long time. We have those things in place in Idaho going back to 2019. So it's great that it's all coming together to be kind of accelerating at the right time.
Well, thank you for joining us to keep us posted on the progress. Jake, it's good to see you
Thanks
again.
for having me. Yes.
Jake DeWitt, the CEO of Oklo. And by the way, in that Senate rewrite of the bill, we talked a lot about solar credits going away, but actually nuclear, geothermal, and hydropower got an extension of the credits, so they were spared. Clearly a priority.
Yeah. After the break, the CEO of Kava is with us. Brett Schulman will talk about his read on the strength of the consumer after today's retail sales print. Meantime, it remains an inside day on the S&P, down about 20. Stay with us.
Good Tuesday morning again. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, consumers pulling back. New data showing a bigger drop in retail sales than expected last month. The CEO of Kava joins us to talk about spending habits and the outlook for inflation.
Jamie Dimon set to speak this hour at a business roundtable event. We're going to get you those comments as soon as we get them.
Plus, Citadel's Ken Griffin addressing the firm's new class of interns, sharing those remarks exclusively here with CNBC. We'll bring you his advice coming up.
Meanwhile, been modestly in the red since the open. Dow's down about 80, but we are holding S&P 6K by about 13 points. Breadth is modestly negative. Energy is the only sector green at the moment, and the VIX, although sub 20, is not too far away. Let's start at the G7 summit in Canada. The president's early departure last night made some headlines as fighting in the Middle East intensifies. Our Megan Casella is on the ground in Banff with the latest. Morning again, Megan.
Hey, good morning again, guys. Carl, that sudden and surprise departure was by far the biggest headline coming out of this summit and the biggest moment as well. The president scrapping quite suddenly plans for his whole day today that included sit-down meetings with the presidents of Ukraine and Mexico, as well as some other closed-door private sessions as well. The White House, of course, saying he had to get back to Washington to focus on the ongoing conflict in the Middle East. And we do expect that President Trump will be spending much of the day today in the Situation Room with his national security team. A U.S. official confirming over overnight that he had asked that security team to be ready and prepared in the Situation Room as soon as he landed this morning, which happened at about 5 a.m. Eastern. The question now, of course, is on whether the U.S. is willing to help Israel in these attacks or whether they're continuing to push for a diplomatic solution. And to that end, the German Chancellor Friedrich Merz just spoke here at the G7. And according to a German broadcaster, he said if Iran does not back down, complete destruction of Iranian nuclear program is on the agenda, which Israel cannot achieve alone. Of course, the U.S. has always been expected to have to get involved in order to get to that step of complete annihilation of the nuclear program. For his part, President Trump not showing his cards just yet as to which way he'll go. He told reporters that he wasn't looking for a ceasefire on Air Force One, and then he said this. Take a listen.
What specifically is better than a ceasefire? What are you looking for here?
An end, a real end, not a ceasefire. An end.
So something that would be permanent.
Yeah, or giving up entirely.
As for the rest of the G7, guys, it does continue throughout the day today. Again, I'm surrounded by international media whose world leaders are still here. The president said he accomplished what he needed to do yesterday. We can confirm he met one-on-one with nearly every G7 and EU leader, the one question mark being Italy's Meloni, that we're not sure whether they did meet privately. But despite all those meetings, not much tangible progress on the trade front, which was the one thing the White House and other countries had really been hoping for, is some sort of deal or at least major momentum. The president saying on his plane that when it came to the EU, he said, we're talking, but I don't feel that we're offering a fair deal yet. As for Japan, he said there's a chance of a deal, but they are tough. But guys, I will say Treasury Secretary Scott Bessent remains here, we think, as the sole member of the U.S. delegation that's still at the G7. There could be more talks on trade today. We've asked the Treasury Department, and they haven't told us just yet, but we'll bring you more on that as we have it. Guys.
Yeah, Megan, you mentioned the German Chancellor. The other thing he told ARD, the broadcaster, is that we could expect a deal with the U.S., I assume he means the EU, with the tariff dispute before the summer's over, which I thought was somewhat constructive given some of the comments about those negotiations we got from the Commerce Secretary last week.
It's an optimistic take. The president has long been hard on the EU. We heard him repeat this again last night. He feels that the European Union was formed to be competitive and to sort of take over the United States and take over them economically, at least. Always says that they're tough, doesn't like that he has to negotiate with 27 different nations, or that at least 27 different nations could have a say in those talks. Interesting, though, that you say Merz said by the end of the summer. We know July 9th is the deadline. That suggests there could be a little bit more of a runway there. We know U.S. officials have been open to delaying the deadline if they feel like talks are moving forward. And the other thing I've been thinking about this week and talking to some folks about is just how much is on the White House's plate. We already know that after last week, they said we haven't seen some of these side deals because they were focused on China. Now, of course, they're focused on what's going on in the Middle East. The question being, will they have time to negotiate any of these agreements? Maybe that's what we next hear is it's just a matter of timing, that they'll need more time, and maybe that's why they ultimately extend that deadline.
Yeah, which will be a question, whether they extend the 10% tariff reprieve or whether it'll go up on some places like Europe. Megan, thank you very much. Megan Casella and Banff. Let's get the read directly from the Middle East. NBC News chief foreign correspondent Richard Engel on the ground in Tel Aviv. Richard.
So Iran had promised a ferocious response. Yesterday, Iran was threatening to carry out a missile assault against Israel, the likes of which this country has never seen. So far, it hasn't materialized. There have been several relatively small barrages against the city, against this country. There were air raid sirens here in Tel Aviv not long ago. There were more sirens, more incoming missiles earlier this morning. But in each case, there were only a handful of missiles that were fired, and according to the Israeli military, the majority of them were knocked out of the sky by air defense systems, or they fell in open areas. No reports of casualties. I was at one of the sites a short while ago. It was in just north of Tel Aviv in Herzliya, and the bomb, a ballistic missile, landed by a bus depot, a parking lot where the sort of a bus storage area. I saw a deep crater in the ground, perhaps 15 feet deep, and it burned all of the buses in the area. So it gives a sense of how powerful these weapons are that Iran is firing. But we are not seeing the same level of fire that Iran was launching at Israel in the early days. It could be a sign of diminished capacity. Israel has been hitting Iran relentless. It has been hitting missile defense sites. It has been hitting missile launch sites. Israel says that it has now complete domination of the skies over Tehran. So it could be that Iran is holding its powder, or it's just it doesn't have the same capacity that it did even a few days ago.
Richard, appreciate the update. Always of value to the viewer to hear from you. Richard Engel of NBC News. Meantime, markets continue to digest the fighting in the Middle East, as well as the weaker than expected retail sales number we got today. Biggest monthly decline we've seen since March of 23. Joining us this morning with his outlook, DWS Group America's CIO, David Bianco, is back. It's great to see you, David.
Good
Thanks
morning.
for coming in.
Thank you.
Were you moved either way by retail sales?
I've been keeping an eye on the retail sales reports, but the consumer is a part of the economy that tends to be always resilient. And if you look at the core data, both for May and April, still positive, still spending. Of course, a lot of anxiety about higher costs, partly related to the tariffs, but still, services are still an area where costs are running high. If you own a house and you have to pay the taxes, the maintenance, the insurance, the electric utilities, that's something where a lot of people still see a high cost of living.
Right. We talked about some of the weakness in restaurants and bars, but the auto figure kind of does point to the pull forward effect.
And that also points to where there's the most anxiety about tariffs and affordability. Now, cars have gotten expensive, and the financing on cars has gotten expensive, and they may get more expensive, particularly on imports. So this is why the consumer sentiment has been weak. Investor sentiment seems to be a polar opposite, inured to any kind of shocks or geopolitical tensions. That's in large part because of tech stocks, and they've delivered. The valuations are really expensive, though, so we're trying to find alternatives and trying to protect gains as we go into the summer.
Not just tech, though. Energy is the best performing sector for the month. I mean, healthcare has also staged a little bit of a comeback. There's signs that it's broadened. So are you saying that the market is being too complacent about some of the risks?
The market is overly shrugging off the risks and, in my view, not demanding enough compensation for the risks, and particularly in the bond market on the longer end, the inflation residual risks, the deficit. But, equity investors have tech. As you said, earnings and performance have broadened year to date and even late last year. Financials is a notable one. Utilities is a notable one. I think defense stocks have been a better geopolitical defensive play than energy. But, energy's had its moment briefly.
So you wouldn't be adding to positions right now?
Not in energy. I'd be looking for some defensive stocks that have pricing power, utilities, not so much staples, and defensive stocks that have long-term growth potential and on-demanding valuations, healthcare. So short tech, we're not giving it up. When you have the market sell off, when that actually happens, tech tends to be where we look for opportunities. But in the meantime, we're looking to diversify across sectors and even in other equity regions, including Europe.
I was going to say, you don't think Europe's overextended given its gains this year?
It's had a lot of gains after many years of underperformance. The currency has made for better U.S. returns. I think the real debate around Europe is, will they get healthy earnings growth later this year? You're seeing earnings growth at financials in Europe, and you're seeing earnings growth at European aircraft and European electrical equipment. So there are the bright spots. But the overall European economy at risk to these tail risks in the world, and the underlying profit trends in Europe, excluding financials and certain industrials, still weakish, and the tariffs won't help.
You think the Middle East affects Europe, of course, as a concept for investing? If this gets worse?
It does, which is why I say that Europe is still exposed to a lot of the tail risks. But Europe is, it's aligned with the United States. It sees the world we live in. It's become much more realistic. Many countries, including Germany, have sprung to action, not just to bolster their economy with fiscal spending, but to play a larger role in regional and world defense. What the Israelis done here is maximize the optionality to the U.S. and Western allies. Let's see what happens from here. But it's been a more dangerous place, and our allies are helping out more than they've ever done before.
And yet, the market shrugs off the risk, whatever that may be?
It's this underlying security blanket of tech. People used to talk about things like buybacks, but the earnings trends are there. The leadership of these tech stocks remains there. It's hard to shake investors out of these stocks when they've been made rich by owning these equities and sticking with them through thick or thin. But like I said, protect gains. The bull market should continue over the coming full year and years. But I think this is a summer, whether it be what happens on July 9th on the tariff reprieves or what do the more permanent tariffs look like? What is the one big beautiful bill? Does it get passed by July 4th? What is the deficit implications? How's the Treasury bond market react to that?
Sure.
What's the Fed do? What's Fed leadership changes outlook? Plenty to think about over the summer. Why don't we try to diversify and protect gains?
Finally, you mentioned the long end. What do you think those holders deserve to be paid, given the concerns you raised?
Right. Well, we're not too far below 4.5% right now, which is our forecast for the coming year. That's a number that seems plenty reasonable and far more compensating than past decade or two.
Right.
But the deficit is a much bigger concern than it's been in decades. And now we also have to keep an eye on how the Fed handles. I think what the Fed needs to do is make sure that it keeps the confidence of the long-term bond investor rather than trying to ride to the rescue with a small cut that, the consumer's been resilient, jobs are fine, the economy's solid. Keep the confidence of the long-term investor, both at home and abroad, because that's the greater risk to the economy, long-term yields.
By doing nothing?
By doing nothing until it's clear they should do something. And if there's a recession, they'll act. Doesn't seem
If there's recession, they're too late.
No, because I think if there's a shock, geopolitical, then they're right on time. But just trying to kind of get ahead of the curve, and since the economy is slowing and therefore slipping into recession, I don't think so. The economy can slow. That doesn't mean we're slipping into recession. Yeah, I think the longer-term threat is to housing and asset values if 10-year Treasury yields do to go to 5% or higher, and that's why I think the Fed needs to stay disciplined here.
Right, that explains the home builder sentiment number this morning. Yeah.
Exactly. So put on sunscreen for the summer, but don't dig yourself into the ditches.
David, thanks. Good to see you.
Thanks for having
me. David
me.
Bianco.
Still to come this hour, retail sales, as we were just talking about, missed this morning. We're going to have a closer look at the consumer with the CEO of Kava. The stock losing about a third of its value this year, but the company's still pushing ahead with its expansion plans. We're going to get to all of that next.
Lilly's a story today, announcing yet another deal this morning on its acquisition strategy. We're going to dig into that and maybe some diversification for Lilly when we're back in 2.
09.
Welcome back. Retail sales today coming in worse than expected for May, weighed down by gas sales, but also bars and restaurants saw a decline of nearly 1%. That was notable as the services part of the report. Joining us in an exclusive interview from the Jefferies Consumer Conference is Kava co-founder and CEO Brett Schulman. Brett, it's good to have you back. Kava shares, they've been hit lately. I think you warned of economic challenges in the last quarter, so I'm wondering what you're seeing out there right now.
Yeah, well, it's great to be back with you. I think in general, I think the numbers are indicative of is the fog that's hanging over consumers. You think about all the macroeconomic fluidity, whether that's tariff policy, immigration policy, government spending policies, and then you add on top of that all of the geopolitical uncertainty that's been increasing. And when consumers are in a fog, you don't tend to accelerate or kind of step on the gas. And I think consumers are looking for that fog to lift to say, I have that clarity to lean forward, and I think that's what you saw play through in the numbers.
How does that affect a company like Kava, where you have such a strong growth profile that's driven by, increasing brand awareness and store expansion?
Well, no matter what the near-term headwinds are, something that we've noted is the strength of our new restaurant openings, which has been phenomenal this year. We've talked about they've opened even bigger than last year, whether that's an urban market like a restaurant we just recently opened in Phoenix, or a suburban big city market like Chestnut Hill up in Massachusetts, not far from where we are, or small towns like Burlington, North Carolina, or Lafayette, Louisiana, that we've also opened in recently. We've seen consistent strength across our new restaurant openings, which make us even more convicted than ever in the long-term opportunity and the white space potential of building the next large-scale cultural cuisine category in Mediterranean.
Brett, you mentioned the fog, which I think everybody understands. Is there a density to the fog that would eventually begin to weigh on your unit growth strategy?
No, Carl, that's one of the things we talked about when we went public, to really have an ironclad balance sheet, free cash flow positive last year while funding 18% unit growth. And so we want to be unwavering in our long-term strategy to really build that next large-scale cultural cuisine category that we continue to define and lead in.
Are input costs moving in either direction, either for the good or the worse?
We've seen input costs be pretty benign, as relates to COGS or labor, and that's what we've really worked to pass along those savings to our guests. So we only took 1.7% menu price increase at the beginning of this year. No plans to take further price increase, and we've been able to underprice inflation, underprice CPI over 800 basis points in the past few years, really trying to drive that value proposition for consumers when they're in that fog or feeling other price pressures around them.
Yeah, and also menu innovation too, right? As a driver, I think a lot of analysts are wondering about what you've got coming on the menu, how things like the chicken shawarma tests are going, and other new stuff.
Yeah, so we're very excited about that. We recently launched a new flavor innovation of our fan favorite pita chips, our hot harissa pita chips. And in the fall, currently in test now, as you noted, chicken shawarma. It's a spit roasted chicken breast with shawarma seasoning. It's delicious and it's testing really well. And we plan to roll that out in the fall as another new great innovation that our culinary team is bringing to market.
We had a discussion this morning about some consumer packaged foods losing dyes. Kraft Heinz is a good example today. I'm sure you have a generation of diners who maybe are graduating off of GLP-1s and don't want to gain it all back. And I guess that kind of all funnels into your sort of health-conscious food message to consumers, does it not?
Yeah, Carl, that's where the trends are really coming our direction, whether it's clean, wholesome food like we've been serving since our very first restaurant opened, or the Mediterranean diet, #1 ranked diet 8 years running, and this idea of satiating food that's flavorful and, oh, by the way, healthy for you. And so when you look at some of the data and the research that's been done on the GLPs, it's actually shifting people more to our style of eating: Greek yogurt, chickpeas, legumes, food that's satisfying and nutritious at the same time, that unique cuisine where taste and health unites.
So how underpenetrated are you at this point? What does the roadmap look like?
Yes, Sarah, we have a goal of 1,000 restaurants by 2032, and that's just a point in time. We think our opportunity is much bigger than that. We're approaching 400 restaurants today. We're in 26 states in the District of Columbia, and what gets us so excited is when you look at our current footprint, as I noted, it's everywhere from the cities to the suburbs to small towns to every region of the country. We're seeing consistent performance strong average unit volumes and great acceptance and appeal of a cuisine that most people are trying for the first time. And when they try it, they love it and they come back.
I mean, the stock's really taken a fall, Brett, despite the fact that you're still comping double digits and you haven't changed your expansion plans. What are you hearing? You're at an investor conference now. What are you hearing from investors and what are you telling them to reassure them?
Well, we're coming off a tremendous year next year, and the stock is certainly at lofty levels and pretty high multiples. And as you've been in kind of a risk-off market in general with the geopolitical and the macroeconomic uncertainty, you've seen that settle down to a more normalized level.
So you think it's really macro concerns and high expectations, which has been the story since you went public.
Yeah, again, in the public markets, there's some short-term investors, there's long-term investors. You see some of the uncertainty and the risk in the market that's been more risk-off this year. But that's why we're focused on the long-term value creation opportunity of really building out that next large-scale cultural cuisine category and driving that new unit restaurant productivity, which we've seen be stronger than ever this year.
I think the last thing I'd throw out at you is we've heard from some of your peers in like the beverage space, for example, that the cost of a new unit, in their view, was getting a little rich. Is that rhyme with what you're seeing, or are you getting some relief at least on the labor and material side?
Yeah, we haven't really seen an inflationary impact on the CapEx side as it relates to new unit construction. So we've been able to deliver great cash-on-cash returns, which again is really the driving force of value creation in our business, as we're able to build new units at a reasonable price and then drive great profitability to pay back those units and drive that free cash flow that we've been able to produce in the past year.
All right, Brett, thank you for the update. We appreciate you talking to us as you speak to investors there at the Jefferies conference as well. Brett Schulman, Kava founder and CEO, and Carl, when he talked about lofty multiples and expectations, I mean, it's still trading 63 times earnings, 129 times next year's earnings. So there are very high hopes for the expansion of this brand.
Yeah, that's kind of led to some downgrades at McDonald's in the last few weeks, or some rich multiples in restaurants. Still ahead this morning, Lilly announcing this new deal in the gene editing space today. We'll get more on the company's growth strategy when Money Movers continues after this.
Testing audio. Just quickly want to go over my trades, why I went long on most of my trades. I think all of them. Just 1 second here. So I hope my audio's coming through. There's no issues, I hope. Okay. So let's zoom this in here a little bit. This is the 2-minute chart, this is the 5-minute chart. Show fills. So right at the open, as you can see, I went long. And the opening is right over here. So I start adding and start getting out at around, 22,100 and change here. Then I start adding, and got out because this pullback was a little bit too deep than I liked, and as you can see, and it just came down again. So I held on to one trade, one contract. But the reason why was, let me show you here on the 15-minute chart. So here's the opening bar. Let me see, 15. This is the opening bar, right? So we were sitting above the 200-day moving average. We had this move up. Early morning, overnight, and then pull back, and then I saw this bar form. So I thought we'd be going higher, and we did. But then again, like around 22,100 and change, there would be resistance. So that's why I started getting out. And then it just reversed, and it created this topping tail. But then I started adding once it cleared the body of this candle. I don't know if you can see this. Let me see. I think it was right around here. Yeah, these trades here. So I start adding, and then I start getting out right again. The tail is resistance, right? So there was a lot of selling going on. So that's why I start getting out for a good reason. But it did close, nice strong green bar. Then it had a pullback, and then produced another green bar, bottom tail. It closed above these two resistance points, but we had a pullback. Then again, this My hiccups. Another green bar. But as you can see now, we took out like 70% of this bar. So that's a problem. That's a problem. That's too deep, too much of a pullback. So now it looks like it might be taking out this bar completely. And we have 10 minutes, 9 minutes or so left in this bar. So I would not be surprised if we go down all the way down to the 200. It's going to be some kind of a reaction at the 200-day moving average and at these two, well actually 3 points of support. So 22,000 is definitely would be one of my targets. 22,000 and 22,015 or 20. So 20 points apart. But let's see what it looks like on a 30-minute chart here. Yeah. So if we close below this bar, the green bar, so we have 23 minutes left on this bar, so it's anything can happen really. But there is resistance up above and support down below, as you can see. So we might be trading in a range, and then perhaps towards the end of the day, we'll see the big moves. And the 1 hour chart looks like this. So if this, so we got 22 minutes left in this bar. It's 8:37, so 20 minutes or so left. If this produces another bottoming tail, topping tail, we definitely going down. So again, the moving average, the 200 is 22,025 or so, and I said 22,000. Yeah, so aligns with the other time frames. The 4 hour chart looks like this. Can't really do much on a 4 hour chart because it's 4 hours of price action. So, but if you're a long-term trader, this would tell me it's going to go higher, right? But it's pretty. So we'll see. And the daily chart. This is the new contract, the U. Yeah, I don't really want to look at this because it doesn't. Yeah, so that's why I went long most of my trades. All of them, actually. All my trades were long. I wasn't a drawdown well, I was in profit, but the trade itself was in a drawdown, if you were watching. But I was in profit overall at all times. So we'll see what happens. That's why I took the trades that I did. Let me just take these.
Ever higher in doing this. You know, over the last couple of days, Emmanuel Macron took the terrible decision to try to cordon off the Israeli defense installation and booth at the Paris Air Show. You don't need to go there. Yeah, you don't need to go there. You just go to Tehran. Everyone sees what Israel is capable of in the innovation. So there'll be defense innovation. There's cyber innovation. There's fintech and financial innovation, because obviously tracking terrorist money breeds a lot of innovation in finance and in crypto and in other areas. And we're just seeing the most remarkable companies walk in the door, by the way, and that's true in the semiconductor supply chain also.
But the Waldorf, I mean, the Waldorf exhibit at the Paris Air Show, I do wonder if it says something about foreign direct investment and investors, you know, that have usually poured into Israeli startups. Has that made it tougher? Has the events made it tougher recently?
We have not seen it. In fact, I'll tell you a story that happened yesterday. The CEO of a very, very large fintech company in the United States, who I had the fortune of having lunch with a couple of months ago in California, and we talked about their commitment to investing in Israel. They actually had a couple of people who got stuck in Israel when the war broke out and got their way out via the Jordanian border. But I reached out to him yesterday and I said to him, hey, has this dimmed your interest in investing in Israel? He wrote to me, dimmed? It's undimmed. Not only that, we want to double and triple down. So I think people who were committed to Israeli innovation before and people who appreciate it are doubling down. I think some of the European leaders are confused, quite candidly, and perhaps some of them, influenced either by local politics or other things, won't turn up. But the net is positive. And Andreessen Horowitz just announced last week that they're doubling down on Israeli innovation. We've seen it from Sequoia in the venture industry. And by the way, we should point this out. Since the beginning of the war, the Tel Aviv Stock Exchange is up, and the shekel is stronger against the dollar. That's remarkable. Who would have believed that?
It's basically near all-time highs. Michael, you know, one thing we're monitoring here in the U.S. is this notion of a brain drain out of America. The Japanese are trying to fund attracting some talent. The Canadians are at work. I wonder if you think the Middle East, or specifically Israel, benefit from either our immigration strategies here or the lack of funding on some research.
So the Israeli government and some private philanthropists have introduced a recent plan to give, I think it's like $1.5 million per year for people to open up AI labs and synthetic biology labs in Israel. There are 20 spots initially. There are over 40 applications in the first month and a half. People want to move to Israel. We're like the only country at war in the world that hundreds of thousands of people are trying to get back to. So people want to move here. I think anti-Semitism on college campuses in the United States and in Europe is starting to move people towards Israel. I haven't seen any effect from the defunding of scientific research in some of the American institutions per se, but it could impact it. And I still think that the United States and Israel are the two greatest places to innovate on planet Earth. And I think that will be true in defense. I think it'll be true in AI. And I hope that this alliance will generate technologies that improve the West. You know, Israel's fighting the war of the West right now against this diabolical Iranian regime that has done a tremendous amount to harm America and obviously Israel. And the technologies developed, and President Trump's talked about the incredible American military technologies. These need to be developed. And it's moving, by the way, from academia to entrepreneurship a lot. And so we need to dig into that and double down on it. I think it's going to happen between these two countries.
What about, I mean, obviously this is going to put a dent or drive up debt to GDP. There are implications for the finances. You mentioned the resilience of the economy, but I do wonder what the cleanup is going to be here, what the debt is going to look like, and just how resilient things are going to look when all is said and done.
Sarah, you've hit on the absolutely key issue. So there was an issuance of bonds yesterday, which was like 35 times oversubscribed at about a 5.5% interest rate, which is above what the U.S. needs to issue at even today. So Israel's able to raise money and it's able to repay it. And our debt to GDP ratio is better than almost any Western country, including the United States, including the UK and others. However, and I think you've hit the exact right issue, we're going to need the political willpower to invest more in growth and less than spending. And that's going to mean cutting some of the superfluous welfare state. And that's going to take political willpower, especially vis-a-vis some of the coalition partners in this current government. There is not going to be the luxury to invest in coalition politics. We're going to need to invest in the core of the economy. We need to generate growth. We have demographic growth. We need to generate GDP growth that is meaningful in order to repay these debts and keep our debt to GDP very healthy. I should remind you, after the Yom Kippur War, there was like a lost decade, but our economy is 30 times the size today. And it's a $500 billion economy and still growing. And so, but we need those government dollars to invest in growth and not in transfer payments to welfare, et cetera, if we want to grow the economy out of this.
Well, it's really good to hear you so enthusiastic about the economy and the resilience of the tech scene and the business community. Michael, thank you for joining us with the report from
Sarah, if I could just add one thing. I want to add a hopeful note. When this war is please God over with the Iranian mullahs, we can create an era of prosperity for the Middle East where the Iranian people can join IMEC instead of the Belt and Road Initiative, and we can create a zone of prosperity here that's 300 million people large. I think that's a tremendous opportunity we got to stay focused on going forward. Israel is the heart of innovation. The Iranian people are innovative as well. So I really hope we'll come together in brotherhood. We had relations until the mullahs took over, and I think there's a lot of hope for the future.
Michael Eisenberg, thank you so much for coming on. Really good to talk to you, as
Thanks,
always.
Sarah.
From Aleph, the sense of the spirit there.
Still ahead this morning, some new reports about cracks between OpenAI and its biggest backer. You know who that is on the other side of this break.
NBC Plus.
One of the longest standing partnerships in AI might be reaching a breaking point. OpenAI now growing frustrated with its obligations to Microsoft. That's according to some reports. For today's Tech Check, our Deirdre Bosa is talking about how this could be a part of a bigger realignment in the industry. Hey, Dee.
Hey, good morning, Carl. So theirs is the most public falling out, but this isn't just about OpenAI and Microsoft. What we're seeing is a much broader realignment, where strategic alliances may end up mattering more than who has the best model. Now you've got big tech, infrastructure players, deep-pocketed investors like SoftBank, all moving, trying to lock in talent and distribution before the next phase of the race begins. And that is what makes the growing OpenAI-Microsoft tension so striking. It was once the AI partnership, widely seen as the most strategic and the best aligned in the industry. Microsoft brought the capital and the data centers. OpenAI brought in the talent and the breakthroughs. But now they're both diversifying. They're increasingly competing with each other as well. Microsoft building its own model, even featuring Elon Musk at its developer conference. That is a signal that it's open to new model partnerships. OpenAI, meanwhile, it's working with Oracle and reportedly Google, pushing for multi-cloud access. It's moving deeper into enterprise and defense. Tens of billions more it's raising as it tries to convert into a for-profit company. That is a move that would give it even greater control over its future, but would also squeeze Microsoft's stake and strategic leverage in the process. Now, since Microsoft first invested $1 billion back in 2019, its own shares have more than tripled. It has since poured in some additional $13 billion in capital. And now, as that stake risks becoming diluted through OpenAI's for-profit conversion, the question is really whether Microsoft's early bet still gives it enough leverage in what comes next. Going back to that first partnership announcement, guys, it's very interesting to see how much AGI, artificial general intelligence, the next leg of this race, how much that factors in. Because the deal included a clause that once OpenAI declares AGI, the partnership ends. So maybe it's no coincidence that this year Sam Altman keeps talking about it, how close they are. That could be a negotiating tool. It could be a deadline. It could even be a way to reset the terms entirely. But I think it's clear we haven't seen the end of this tension anywhere close to it yet.
That doesn't say great things about what an empirical, truthful landmark of AGI, when it might come, right? If he's using this as a chip.
Yeah, absolutely. You're right. And I think that there's a lot of growing evidence that we may be further away than we even thought. There was that Apple paper on reasoning models throwing a little bit of cold water on how smart they actually are. They're not the only ones. Anthropic has thrown cold water, a Chinese lab as well. That kind of goes against the idea that we are close to AGI because the models, they break down after a certain point. But clearly it would be in Sam Altman's incentive. He has a real incentive to say that they're close because it changes this whole Microsoft partnership that is breaking into the open now, some of the cracks in it.
Do they just not need them as much anymore?
Yeah, I think there's a huge realignment taking place. They need capital, right? And Masa-san at SoftBank has a lot to provide. I mean, they can partner with Google, which they reportedly are. And it may also show on the Microsoft side how they're looking ahead to the next leg of the race, that maybe they're not willing to spend as much. Maybe they want to be a little more cautious in terms of CapEx. They don't want to keep pouring money into OpenAI, which is still losing money, right? So it says a lot about where each of them stand and where they think that this race is going.
Okay, thank you, Deirdre. Deirdre Bosa. Still ahead, exclusive sound from hedge fund titan Ken Griffin. The advice he just gave the incoming class of interns at Citadel. When Money Movers comes right back.
Check on a few big movers this morning. Jabil Circuit leading the S&P 500 after beating earnings expectations this morning. Company raising its fiscal year guidance, with the CEO saying its intelligent infrastructure segment is a critical growth engine and is benefiting from accelerating AI-driven demand. Reddit shares rising again after the company announced 2 new ad tools. Company announced what it's calling Community Intelligence, which will tap into the platform's content and use the data to provide insight to ad clients, power its new ad products. And then solar stocks on the move today. They are plunging after the Senate released its version of the spending bill, and Pippa Stevens has some more on that this morning. Hey, Pippa.
Good morning, Carl. Well, solar stocks are dropping, with the TAN fund on track for its worst day of the year, down more than 9%. Now, there had been optimism that the Senate versions of the tax bill would be better for the industry than the House's, and the TAN fund actually rose in 9 of the last 10 sessions. But then we got the actual text, and there are not hugely significant changes for clean energy credits. The Senate's bill has a slightly longer lead time for projects to begin construction and still be eligible for the credits. And there is also a slower step down, with projects breaking ground in 2027, still receiving a 20% credit. But the credit would expire in 2028. That's 4 years earlier than what's in the Inflation Reduction Act. And residential solar is the hardest hit, with the lucrative 30% tax credit expiring 180 days after the bill's enactment. Under the Senate's version, which is sending Sunrun, you see they're cratering 42%, and Phase and SolarEdge, which make hardware for Resi systems, also dropping. As Guggenheim's Joseph Osha put it, while a lot can still happen, hoping for a fix continues to be naive. Sarah?
All right, pretty ugly session for those solar stocks. Thank you, Pippa. Citadel CEO Ken Griffin speaking with the incoming class of his interns last week at Citadel, sharing insights from his career, advice for those just starting out. He shared some of those remarks exclusively with us here at CNBC. Listen.
The first question is, put yourself in the room with the colleagues. If you're the smartest person in the room by far, you're in the wrong room. Like, you need to find a different room to get to. You should never, ever say, I am the smartest person in the room. You may be the smartest person in a particular topic, particular area of interest, but if you are just hands down the smartest person in the room, you are in the wrong room.
I'm in the wrong room. Just kidding. He went on to say that he is humbled at work every single day. By the way, if you were wondering where folks want to intern at Wall Street, it is at Citadel. They received 108,000 applications for their internship program, I'm told. A 20% increase from last year. Only accepted a few hundred. So they can boast a lower acceptance rate than Harvard and MIT.
It would be less than 1% easily, yes?
Yeah, it's like 0.4% right. Or something like that. High demand. That's what happens when you're at the most profitable hedge fund in the business right now.
Yes, and learning from Ken. That's pretty interesting. Meantime, we have maintained some losses, albeit mild today after the weak retail sales print. And then, of course, the signals of escalation in between Israel and Iran, although we continue to monitor the headlines. Meanwhile, there's been a couple trade headlines from the EU saying they're still thinking about a July 9 deadline. We'll see if we can get that before some of those tariffs.
I'm sure they
potentially.
are. But President Trump yesterday on the sideline said they haven't offered a fair deal. So it remains to be seen. They have to offer him something that he's going to want. And what he hinted at yesterday with Carney is he wants tariffs. He wants tariffs in some form to stay in place when it comes to bringing goods into the United States.
Said, I'm a tariff person, and Carney's model is, what did he say, more complicated?
More complicated. Didn't go into it. He said, we'll look at it, but it's a little more complex than that.
So we'll look for the Fed decision tomorrow. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The edgy markets, retail sales weaker, the VIX rising, tensions high, of course, in the Middle East. We're trading all of it with the investment committee this hour. Joining me, Josh Brown, Stephanie Link, Shannon Sakosha, Brian Belsky. We will go to the markets and have a look at where the trade is at noon in the East, and we are modestly red across the board. Steph, our retail was weaker than expected. Biggest monthly drop since March of 23. Figured it probably would be because of the big pull forward going into the trade war and the tariffs. And Roth Capital today says the bull trend, though, is underway. There's plenty of support. Breadth continues to improve. Last week, the percent of Russell 3000 names above their 50-day reached 80%. That's a key characteristic, they say, of a bull market.
Yep. The consumer is just fine. We did see pull forward because of the tariffs, but the average number year over year was 3.13%. and that's still pretty healthy. The average for the year so far, every month, 5 months, actually it's been 4.4%. So you're down a little bit, but you're not down a lot. The consumer is still just fine given the labor market, given that inflation is coming down. And oh, by the way, the control group actually was pretty decent. So the GDP number is going to stay strong, which bodes well for earnings. So I still come back to the facts that we got a couple of weeks ago: personal income and personal savings. And personal income at 0.8% was 3 times what people were expecting. And personal spending was 0.2%. So a little soft, but that means your savings rate is actually much higher than the normal, and that's a good thing in case we do slow down. I think the consumer is in better shape at this go round in the cycle.
The other point we brought up yesterday, I'm just reminded of, is that Goldman report of people having like 48 or 49% of their financial assets in equities in the stock market. And if you're 2% from a new high, you're feeling pretty good, I think, through all the trials and tribulations of where we've been already this year. Josh, the Bank of America Global Fund Manager Survey calls sentiment at a Goldilocks bull level. They say the trade war and recession fears have abated. The cash levels have dropped to 4.2%, was 4.8 in April. Maybe there's a little more buy-in to this story, feeling like it's gotten a little better.
The thing to understand about the Global Portfolio Survey is that these are people whose livelihoods depend on them not missing out on massive rallies. So it's okay to have more cash when the President of the United States lifts up a piece of cardboard and says we're going to tariff the rest of the world 100% or whatever the number is on their goods. But once that piece of cardboard comes down and the real numbers start to surface, you can't just sit there and be like, no, actually, I think he was serious, and we're going to wait until the actual tariff news. Once the market figures out, hey, this is not going to be a worst case scenario. This is not going to wipe out 2 quarters worth of earnings. This is not going to crush the U.S. consumer, which is the most important engine of global growth. Then you have to decide, okay, maybe I don't want to be 70% cash. maybe I want to be 30% cash, and I'll find some stuff to buy. So that's exactly what's playing out. In the end, global portfolio managers are portfolio managers professionally, and if they sit completely in cash, completely risk off, and the market tells them they're wrong, the clock is ticking. They've got to ratchet up. So I don't look at them as a contrarian signal. I don't worry too much about this. I'm not one of these people who sees other people being bullish and instinctively has this knee-jerk reaction where it's like, well, that's it, time to take profits, everyone else is long. I just don't look at it that way. The way that I look at it, the stocks that matter are delivering. Magnificent Seven stocks are part of the formula that saved this market from a full-blown bear market when they reported earnings in late April and early May. 27.7% growth for that group. That's versus 9.4% growth for the rest of the S&P 500. And most importantly of that group is what NVIDIA did. NVIDIA is 26% of the S&P 500's total return year to date, stock price. And it'll be about 17% of this year's earnings growth. If you understand that the AI story and the U.S. consumer are the only things that matter, you could stop wasting your time reading a lot of other data and focusing on a lot of other reports. And those two things, to Stephanie's point, the consumer is fine and the Mag 7 AI theme is intact. If I told you nothing else, that would be enough to understand why we're on the verge of a new record high.
I mean, Brian, 50% off the April low is NVIDIA. The other Mag 7 stocks aren't quite that big, but they're big. Meta, 37.5% off the April low. Microsoft, 35. Amazon, Alphabet are 27 and 22 respectively. You know, Apple's been lackluster relative to a lot of other names in this group, but even that stock's up 15% from the April low. Are you poised to believe Roth Capital and say there's plenty of support that the bull trend is indeed underway?
Well, I think the bull trend is underway. We're very lucky to remain bullish through all of this. But I would say that there seems to us on a very short-term basis, you're going to be surprised at this, I think there's a lot of bulls out there. And one of the guideposts that we've been looking for is kind of more company guidance going forward, and guidance is falling off a map still. So we're a little bit worried near term on that. Do I think stocks are higher at year end? Yes. Do I think they're significantly higher a year from now? Yeah. But I think even within the Mag 7, I think you have to be even more stock picking. So like we would be adding to Apple here because we think Apple's going to have a big catch-up trade, and we've maintained our overweight stance in Microsoft and Amazon. So that's what's helped our portfolios April, May, June to significantly outperform.
Shan, it's time to just lean into this market, and institutional investors and hedge fund managers, and I like what Adam Parker delivers when he shows up, because he meets with and he has dinners with and these idea dinners and whatnot, and there was a lot of pessimism among the professional crowd. Now, if you look at the fund manager survey and you think about where the narrative has come to, is it time to just be less fearful and cautious and just lean in with stocks 2% from a new high?
Well, I think the pessimism was likely warranted because it felt like the uncertainty that was being created was really outside of the control of any of the portfolio managers of which you speak. I think the other thing that's happening, Scott, is that we have a tax bill that's weaving its way through Congress that has some very specific and explicit and potentially transformational changes in terms of at least tax over the next 4 years or so for businesses. And so if you're looking at, and I would say it's somewhat tangential even to the AI trade, if you look at being able to expense capital expenditure on software over the course of the next 4 years, 100% in the year of your purchase, wow, that actually could create some of this monetization of the AI trade outside of the Mag 7. I think the other thing that's happened is that, we have seen tariffs and we've seen that expected tariff rate continue to come down week over week over week over week. And as that continues, what we're getting is, to Brian's point, we're going to start to get some real guidance in terms of, okay, we think the tariff rate's going to be 12% or 13% or 11%, maybe 10%. But now I can start to price that in. And so I think that this earnings season is going to be very critical in terms of getting the guidance in the hands of investors, and that could allow professional investors who are more discerning around the fundamentals. I think that's why they're getting more optimistic.
Well, the big part of the story is that no one truly knows how the Trump tariffs are going to fully play out. Will deportations that we've seen hurt the economy? There's a story today new from the Washington Post that says Trump officials reverse guidance, exempting farms, hotels from immigration raids. ICE agents have been told to continue conducting enforcement operations at ag businesses, despite concerns about negative effects on the food industry. I wonder if we morph our concerns from what was the trade war and tariffs to just messing up a bunch of industries because you have this policy in place and you don't appear to want to waver from it at all.
Right. We're not out of the woods on tariffs at all, but we are getting more certainty. We think that, it looks like Trump wants to get stuff done quicker than expected, but it's probably going to take longer than expected. But in the face of all that, I'm just so amazed that the GDP numbers at 3.8% are 3.8%.
Yeah.
And I know it's directional, and I know we have to average first quarter and second quarter. That's 2.5% GDP growth. And by the way, I don't talk about it enough. I know you guys do, but the weak dollar, that's really good for U.S. multinational companies. So that's going to be another tailwind for earnings. And I just care about earnings.
But there are two sides to the. I feel like, first of all, you didn't answer my question. So I'm going to come back to you on that because you didn't answer my question. So let me just go to the dollar since you went there. It is the largest underweight right now in 20 years. The dollar's lost 10% of its value since President Trump took office.
Right.
Now, you can go one of two ways on that. You could say, well, that's good for multinationals like you did. Or you could look at it and say, well, there's a direct line of evidence to a lackluster belief in the American exceptionalism trade. You guys are nodding your head like
yeah,
you agree with that.
Wait a second. Let me answer your question on the whole messing up industries. In the face of this happening, we aren't messing up industries.
Well, how do you know that?
Because earnings just grew 12% last quarter.
Well,
in the face of all of that.
Did you get a bunch of farm earnings reports and hotel and restaurant earnings reports?
Did you see Deere? Did you see Caterpillar? Did you see Chipotle, did you see? I mean, there's a lot. There's a lot of companies that have done it the best that they can. Either they are giving very conservative guidance. Sometimes they're not giving guidance. A lot of my companies did, and I was shocked that they just reiterated. How about the whole financial services industry? Every single bank reiterated guidance. Not one of them lowered, and that is really quite impressive because they're at the forefront of what's going on the tariff side.
Now, the dollar thing is a legit part of the story. Falling dollar may be good for multinationals because it traditionally has been, but if you think it's falling for the wrong reason, then you sit back and you take a look at the whole big picture of where we are.
You know, in our view, it was at first falling for the wrong reason with respect to international investors losing faith in the United States. That's clearly why you had Europe massively outperform. And why industrials, by the way, are the most eclectic sector in the U.S. market, have also been one of the best performing sectors, and obviously there's a big international component of that. However, one could say that the majority of the dollar's weakness is beginning to slow down. I mean, the trend is beginning to change pretty dramatically.
I mean, 10% is a big move.
Well, if you look from where it was, but now we're starting to see solidification. Also in the Global Fund Manager Survey, we had the good fortune of being in France and in England to see our great institutional accounts in April, and a lot of those clients have massively overweight Europe, Scott.
Well, you know what they said, since you went back to the survey? That international stocks are going to be the best performing asset over the next 5 years.
Yeah, they're talking, first of all, they're talking their book, number one. Number two, that they don't have the fundamental attributes to be able to match what's gone on in terms of stock price. They don't have the economic growth. They don't have the stock or earnings growth. And so many of the people that we talk to are actually becoming, dare I say, reluctant buyers of U.S. stocks again, Scott, because they have to
criticize
perform.
people for talking their book. You talk your book all the time. So does every single person who comes on the network. Otherwise, do you have any belief in your book?
No.
Like, what are you going to come on and contradict your book?
I talk my process and my discipline in terms of
but you talk
publishing.
about why you think your view and the stocks you have are going to work.
When you're
is that talking your book?
When you're talking to an institutional client that has been, for all intents and purposes, a reluctant buyer of U.S. stocks for 20 years, and they finally were right on Europe for the first time in 15 years, Scott, of course they're taking a victory lap. So yeah, they're going to continue to be on with that because they do have an overall hatred for the United States and yeah, I would call that talking their book and being emotional about it.
Mean reversion in the dollar. Scott, everybody came into this year saying the dollar was overvalued. Nobody said that. Was even before the inauguration. It was before the tariffs. It's before this tax bill and the deficit. So, to talk about the fact that all of a sudden just what's happened politically in the last 3 months is why people are rotating away from the dollar. I think that's somewhat short-sighted. But the point is that this crisis in terms of fiscal sustainability has been building for some time. Now, to Brian's point, people latched on to the German fiscal stimulus as rationale to get excited about Europe. Yep. And there's likely some legs to that. There's a tail to that. There's a transmission to the rest of the continent. But I think, in terms of, it's not a binary decision to move out of the dollar just because of what's happening in politics.
The ECB
there's other alternatives.
The ECB is cut like 10 times versus the U.S. cutting 0. So if you look at, they went into recession first. They're coming out first, and then you have the stimulus of rate cuts.
Right.
Don't fight the ECB. I mean, I don't know what to tell you, but why would you only not fight the Fed?
In an economy that's much more interest rate sensitive than the U.S. economy, absolutely. There are multiple tailwinds here, but to Brian's point, what they don't have is the transformational aspect of innovation.
Well, speaking of rate cuts, we do not expect anything tomorrow other than some commentary that's going to be closely watched, as it always is. Steve Leisman joins us now with more, our senior economics reporter. I read one bit of commentary today of this Fed tomorrow saying, quote, they're going to sit back and see what worsens first, the labor market or inflation. And once they see that, then they'll know which way of the mandate they need to react to more.
Yeah, that's a very easy way to think about it, Scott. That's pretty much boiling down what Chair Powell has said. He essentially said, look, we're going to watch which one ends up being further from our mandated level and which one will take longer to get back to that mandated level and address that one. In our CNBC Fed survey today, Scott, which you can read online, we asked people, how does the Fed essentially, I'll boil down the question, which side of the stagflation does the Fed address first, the stag or the inflation? 54% say, it pretty much is going to address the employment side, but that's down from 65. So the market not quite so sure, especially because jobs have held up, and it looks like to the extent that we are going to have a problem, it may end up being the inflation part of it, where most economists are convinced that the impact of the tariffs in the CPI are yet to come.
Let me just ask you a simple question. I mean, do you think, if not for the president's trade war and the tariffs, that the Fed would be cutting tomorrow?
No doubt in my mind. These nice inflation reports we've had do clear the way for the Fed to take off a little bit more, maybe a quarter, maybe a half, considering that half to be the restrictive part of policy here. And I think it's important, Scott. I think the Fed still wants to take that half point of restrictiveness off of the top line. It just does not want to be cutting into either a temporary or, worse yet, permanent rise in the inflation rate, or more broad rise in the inflation rate that could be caused by tariffs. Talking to some CFOs this morning, as we do in our normal Fed Day call, Scott, what we hear is that people are charging what they call the weighted average price, or some are anyway, which is, you don't take the tariffed good and immediately raise all prices to that, because you have an inventory of stuff. What we saw in retail sales was interesting this morning. It's kind of like the end of the front-running sale that was out there for the consumer. They spent a lot of time and money front-running the tariffs, and now things came off in May. Doesn't mean the consumer's giving it up. It's just likely not as strong as they were before. And then come the summer, they'll likely confront higher prices. Evidence from the import prices is that we are not getting discounts, essentially. So those tariffs are being passed on to U.S. importers. Whether they make their way down to the consumer, that's going to be a matter of time.
Right. It's a tax on somebody. I mean, whether it gets to the consumer level is the great question. Respondents in your survey also predict 2 rate cuts, equal with what the market is hoping happens. I want to read you something that David Rosenberg said on social media regarding the outlook from the Fed and why he views it being so flawed. I have some advice for the Fed. He wrote, ditch the dots. In fact, do what many CEOs have been doing in general and pull out of the guidance. In the context of the supremely high level of economic uncertainty, any numbers this group publishes, will be completely meaningless. That sounds like kind of a reasonable perspective from him, because how could they possibly have an idea of the outlook when the CEOs of this great country don't?
I think the trouble is you get into a consistency issue here, Scott. I think there are sort of, I guess I'd call them procedural problems with the Fed saying, oh, now we're not going to do dots. And I would remind you of the history here, because we're a little spoiled by even having the dots. The dots were what everyone wanted. Back 10 or 15 years ago, before they started publishing them, we were like, okay, tell us where you think policy is going. It really is a luxury. You can criticize them. They can be wrong. But just like doing a survey, Scott, the survey numbers don't mean that they'll be right in the future. They are a 100% correct average of where people think they're going now. It is the current view that is what's informing us about where things are going, and it's accurate in that regard. So the dots tell us where the average or the median Fed officials believe things are going right now, and that is actually an input. And David Rosenberg, in his very commentary, gives a solution to the problem, which is that if there's all this uncertainty, and the Fed chair and other Fed officials characterize it as that, we'll take them with the massive grain of salt that's implied.
I was going to literally say those words right after you mentioned Rosenberg again. Steve, thanks. We'll see you down in D.C., obviously. Yeah. Good stuff. Steve Leisman's going to be in the room. He's going to ask a question. He always does. And when Chair Powell's done, just like we always do, we're going to speak to Jeffrey Gundlach of Double Line exclusively right after that news conference ends. Let's circle back to the Mag 7s for a moment before we take a break, because the Mag 7 ETF is coming off its 3rd positive week. That's the best streak of the year. Josh highlighted NVIDIA, 50% off of its low. The target raised to 200 today. Amazon is going to extend its Prime Day. Everybody on the desk owns Amazon. So how are we thinking about this idea that they are trying to take on NVIDIA with a chip? Christina Partsenevelos, is she ready for us? She's down in Austin today at a AWS event and could give us more details on this growing competition. And then we're going to follow with a story about another mega cap tech company, speaking of competition, that could be in a little bit of a situation. But what about AWS and what's happening where you are?
Okay, so I am in the lab where chips are born for Amazon Web Services. It's called Annapurna Labs. And just an example, this young man behind me, he's looking at a wafer right now. This is literally 30% of the thickness of a human hair. So he's just testing this for clients. And the news today is that they've updated their CPU chip to increase the networking bandwidth. It's going to be the fastest in the public cloud. Timeline is we're still waiting to hear about that, but this is just a step up in terms of technology and really shows how the custom chip strategy is really competing with the likes of Intel and AMD. But the real battle, like you mentioned, Scott, lies with NVIDIA. And that's why just recently AWS announced a Project Rainier, where they're going to be offering hundreds of thousands of chips to build the largest AI supercomputer for Anthropic, and Anthropic will run its latest model on these chips. This is just an example of the Trainium 2 chips that compete directly with NVIDIA. The bread and butter of these chips, though, of course, is obviously performance and all that, but we know NVIDIA charges a lot more for those scarce chips. The secret weapon for AWS here is really the price performance, and they're offering these on the market with Trainium 3 soon, just around the corner, Scott. So that's the difference in why we came here, because normally this lab is top secret. You know, it's very hard to get in, and they're slowly opening it up as they open up everything, and you can see the lovely employees all around me.
All right, great stuff. Christina, thank you. Christina Partsenevelos. So that's one part of the big tech story. The other part of the AI story today is what appears to be, according to reporting anyway, a boiling point's worth of tension between OpenAI and Microsoft. They sure seemed like friends at the beginning, but I don't know what's going on. Maybe they shouldn't have tied the knot, Steve Kovach, because they seem headed to a separation of sorts. What's going on here?
It's like a slow motion divorce happening right now, Scott. No one expects this partnership to last the way it originally was for the long term. So what's happening here? The Journal reported yesterday, as OpenAI is making this transition to a for-profit company, it has to renegotiate everything with Microsoft. Remember, Microsoft owns about 49% of the company, and on top of that, it gets access exclusively to a lot of the latest and greatest technology coming out of OpenAI. And in this case, the quibbling seems to be over this company called Windsurf. It's an AI coding startup that OpenAI wants to buy for $3 billion. Of course, Windsurf would also help Copilot GitHub, which is a coding product that has 15 million subscribers that Microsoft offers. So the two sides seems to be arguing over that a little bit. It seems like Microsoft, though, Scott, has all of the leverage here because of the way the agreement was originally designed. At the same time, though, you're seeing the slow separation of the two companies. Earlier this year, they negotiated a new deal where Microsoft is no longer the exclusive cloud provider for OpenAI. They get the right of first refusal, and we're already seeing companies like Google and Oracle take advantage of that, plus that big Stargate thing. And then at the same time, Microsoft needs that technology to inform its Copilot product. And that is super important, too, because they are very slow to make their own frontier models. I want to play a quick clip here. I interviewed the CEO of AI over at Microsoft a couple months ago, talking about why they still rely on OpenAI's technology so much. Listen to this. I'll get you back on the other side.
It's very important to us that, maybe we don't develop the absolute frontier, the best model in the world first. That's very, very expensive to do and unnecessary to cause that duplication. Once you've waited for the first 3 or 6 months for the frontier to go first, we call that off frontier. That's actually our strategy.
So, Scott, basically they're saying we don't want to make our own technology right now because it's just cheaper to do. And at the same time, Microsoft's Azure cloud service is just making most of its revenue from OpenAI. They're on a $13 billion a year run rate for that AI business. A lot of that's cloud stuff going on. And we're seeing Microsoft open up to other AI models. That includes Meta's Llama model and most recently Elon Musk's XAI model Grok. So Microsoft is definitely playing all parts of the field here, but they have all the leverage in this. And if they can't work this out, OpenAI could miss out on $20 billion in funding from SoftBank if they don't switch to that for-profit model, Scott.
Yeah, I'm sure they could find the funding elsewhere.
Yeah,
Steve
no
Kovac,
problem
thank
there.
you very much.
Thanks.
Which is kind of to the point here, Brian Belsky, the Microsoft shareholder. Microsoft, as Steve said, may have all the leverage now. In my mind, they have by far the most to lose in this relationship.
You know, they do.
How couldn't they?
They do, especially given the visibility and what so many people are banking on OpenAI. But again, Microsoft, with all that cash and the way that it has become really the consumer staple of tech, this isn't going to this decision or what's going to happen with this supposed breakup is not going to change our view on the stock owning it longer term.
All right, we have some breaking news. I want to get to Megan Casella out of Washington. Megan, what do we know?
Hey, Scott, we have just gotten a series of posts from the president about Iran, giving us a little bit more insight into his latest thinking on how to proceed in this conflict. The president posting just in the last few moments on Truth Social that we know exactly, he says, where the so-called supreme leader is hiding. He is an easy target, but it is safe there. We are not going to take him out, kill, at least not for now. But we don't want missiles shot at civilians or American soldiers. Our patience is wearing thin. Thank you for your attention. He went on in a second post to post unconditional surrender in all caps. Scott, both of those coming just a few minutes after he had earlier said something along similar lines, saying that we now have complete and total control of the skies over Iran, that Iran had good sky trackers and other defensive equipment and plenty of it, but it didn't compare to American-made, conceived and manufactured stuff. Nobody does it better, he said, than the good old USA. A couple of things to notice in that post, the foremost one being in all of those posts, the use of we. The biggest question today, Scott, has been whether and just how far the U.S. might be willing to go to help the Israelis in this conflict, whether they were willing to wade in to more fully support those attacks against the Iranians. Using we in both of these posts, raising a lot more questions about the U.S.'s involvement here. In the initial post talking about the use of American military equipment, he had already praised the Israelis late last week for doing that, so not as much new there. But a lot going on in both of these, saying now that we assume, presumably both the U.S. and Israel now know exactly where the Iranian supreme leader is hiding. Scott?
It's still pretty extraordinary when you just consider it in total that, you know, conducting this level of foreign policy by social media post. I mean, especially when you're talking about the leader of another nation, friend or foe. That's not even my point. It's more so conducting this wide out in the open on social media.
Absolutely a huge question there about what's the point of telegraphing it. Is this to give Iran a heads up? Why would he want to give them a heads up about what is coming? Is it more about making the threats publicly so that they viewed them as a message and started to respond accordingly? Is this all about getting the Iranians to the negotiating table? We just don't know that yet. What we do know is that this is a huge break from what we normally see in U.S. foreign policy, which is operated much more closely behind closed doors. We expect, Scott, that the president is in the Situation Room, will be later today, holding a meeting with his national security team. These posts may be coming before that meeting. We don't know the timing exactly, but a huge, huge question as to why so much of this, as you say, is playing out in the open.
Yeah, he let everybody know about that meeting as well. Megan, thanks for keeping us up to date. It's Megan Casella at the G7. More committee stocks on the move coming up next. Plus, Josh is ready with his best stocks in the market once again. We have an update for you. We'll do it after this break. Got a lot of stocks on the move today that the committee needs to discuss, starting with Live Nation. Targets a 162 from 157, reiterated by Josh at Goldman Sachs.
Yeah, this is part of my forever portfolio. Michael Rapino has really done an incredible job threading this needle. You've got a really strong consumer that wants live entertainment. They're willing to pay up for it. But then you've also got all these issues with bots buying the tickets, crashing the sites. You've got stuff going on in Congress about how strong this company is. And he is just persevering, and you see that in the result. This thing has just been rallying for 3 years straight. I don't know what other superlative to attach to it. Great company, even better stock.
Brian, Nike. Target cut to 61 from 70. Reiterated equal at Morgan Stanley. You own the stock. Your verbal reaction to the name sort of tells the whole story, other than why are you still in it?
Well, we bought it around $56, and we bought it in our value portfolio. A big part of a value discipline, quite frankly, is to be contrarian, to think differently. I think from an operational perspective, they have a lot of work ahead of them, so that's why I bought it. So we'll see how long it lasts.
UNH cutting commissions on some Medicare Advantage plans, according to a report. Steph, you own the stock?
Yeah, it's not surprising. Medicare Advantage is what got them in trouble in the first place. So it's going to be volatile until we get guidance. We are going to get guidance, by the way, in next month. I think if you assume a 1% Medicare Advantage margin, that gets you $20 a share this year. And I think you can actually see expansion next year, small, and that gets you to $25 in earnings power, and that makes the stock at 13 times earnings. And I think it's just too cheap for the number one player in the industry.
Let's go to Spotify. Yes. Because the target goes to a street high of $900 today. From the prior $800, it is reiterated a buy at Pivotal. Record high today as well for that stock. Guys, maybe we want to show like a longer thing. Yeah, that tells a good story there. Belsky?
Oh, I love this company. I love this company. I used to own it in my mid cap, and then it graduated to my large cap. I've owned it for 7 years. Who would have ever thought I'd like a company better than Apple in a particular product? Spotify's got a better music product, better everything. I think this is a fantastic company, and because it's not listed in the U.S. and it's not in the index, you can actually increase your tracking area in your portfolio, and that's why we like names like this.
Yeah, 60+% year to date. Up next, an update to Josh's best stocks in the market. But first, the headlines this hour with Courtney Reagan. Hi, Court.
Hi, Scott. Well, federal appeals court will hear arguments today on President Trump's deployment of Marines and members of the National Guard to Los Angeles in response to protests against his immigration crackdown. The court put on hold a lower court's order to return control of California's National Guard to Governor Gavin Newsom. The district judge ruled last week that the president's National Guard deployment was unlawful. A federal jury on Monday found MyPillow founder Mike Lindell defamed a former voting equipment company employee after the 2020 presidential election. The employee sued after Lindell called the Dominion Voting Systems director a traitor and streamed accusations of him stealing the election on social media. And General Motors unveiled a new high-performance hybrid version of its signature sports car. The automaker said today the 2026 Chevrolet Corvette ZR1X hypercar is a souped-up version of the Corvette hybrid that went on sale in 2023 with a 0 to 60 time of less than 2 seconds. The company said the model is the most advanced Corvette ever produced. Halftime report. We'll be right back.
BC.
We are back with an update to Josh's best stocks in the market. I'll send it to you for that. What do you want to talk about?
I think obviously the thing that we have to talk about is the defense sector. We've got a bunch of these names on the best stocks list. We've been talking about them. And last week, of course, they broke out on the heels of the conflagration in the Middle East getting hotter. We talked about Axon and we talked about RTX on May 19th. From that date, RTX is up about 8.5%. Axon's up 5%. Both stocks were breakouts in progress, and they have broken out. So that's the update I wanted to give people. In the column at CNBC Pro, I'm talking about moving up stops and what to do when you've got a winning trade on your hands, depending on whether you're a trader or you're a little bit of a longer-term investor. But those rallies are significantly greater than the Qs, which are up 2% in that time. SPY is up about 1%. I think it's important to just acknowledge the fact that the market sniffs these things out before they happen in many cases. The median return, Judge, for an aerospace and defense sector stock year to date is 17%. The median year to date return for every other stock in the S&P 500 is just 0.7%, not even 1%. Every single aerospace and defense stock is above its 50-day moving average, and only 2 of them are below their 200-day, meaning not yet rallying. Those would be TXT and LMT, Lockheed. So when you're looking for, like, where is the strength in the market, what stocks am I supposed to be in, this is a really smart way, I think, to just say, okay, I'm not going to be ahead of the curve on everything. What is the market already figuring out? These are just two examples of many where the market has already figured out things are heating up in some of these conflicts, orders are coming in, and these stocks are going to work. And lo and behold, something happens, a catalyst, you get that breakout, and now you're playing with the house's money.
Belsky, you own Lockheed, you own Northrop Grumman and Honeywell, so you believe in the aerospace and defense trade?
We do. We look at these as the OG defense contractors. Plus, we're aligned obviously with Josh, but I think you also have to think about cybersecurity along with defense contractors. But these companies are amazing because of the cash flow and the dividends and the consistent earnings, guaranteed revenue from the U.S. government. So that's why we've owned them for a long time.
GE Aerospace for you?
Yeah, but it's small defense. It's only about 25% of total revenue. But they delayed their analyst day this week because of the Air India crash tragedy. I do expect them to have another one soon in the next month or two. And I think they're going to increase their EBIT growth rate from $10 billion to $13 billion by 2028. Free cash flow and mid-20s margins as well. So I still want to be long this stock, but I have to say I do prefer Boeing. It's cheaper and it's more of a turnaround story. GE, it's already turned itself around.
All right, Santoli is next with his midday word right after this break.
pumpkin.care.
Senior markets commentator Mike Santoli at the desk post 9 here for his midday word. Feels like a wait around, see what happens with Middle East, see what Powell says tomorrow.
Yes, for sure. I mean, and in doing so, the market is kind of hanging around the goal, kind of implicitly betting it's not going to have to sprint back on defense. Usually before a Fed meeting, before some other widely anticipated potential catalyst, market wants to, I always say this, get into some kind of a neutral footing. That kind of means 6,000 on the S&P, give or take. I do think you can observe that the rally has held together pretty well, but also slowed and narrowed, and you have these kind of tighter ranges day to day. We're up 1% in the last month. Got like 59.70 pretty much this time last month. So it's incrementally positive, but I do think you have to assume that the market is building in the prospect of some upside risk and some good things happening, whether that means on trade, whether it means, this conflict is going to be kind of fleeting and not something that really causes some kind of stress. VIX at 20 definitely means like you're on alert, but you're not super worried.
Yeah. Oil at 72,
yeah.
At least WTI. It's obviously had a decline yesterday, and it's even as uncertain as the situation is there. It's not like it's moving right back up into the perceived danger zone.
Yeah, it's really not a scary level. I mean, even Friday's highs in mid 70s. I mean, that's something this economy has been able to handle without trouble. So I do think you can look at Friday's levels. The lows in the equity indexes, the highs in oil, where we were in the VIX, and say, okay, if we're not breaching those levels, it means that we are, we have nothing new to be further concerned about.
All right, we'll see you later on the bell. That's Mike Santoli. Up next, the energy trade, oil prices. We just talked about what they have been doing. We'll see where the committee stands. We do have some specific names to lay out as part of Josh's best stock spotlight, too. Welcome back. Oil up again today after that decline yesterday. So 73.80 is where it currently is. Energy is the best sector today and the top performing sector this month. You're probably not surprised by that. Josh Brown, you looked at some of these stocks and your best stocks in the market. You do have 4. EQT, 52-week high today. Expand Energy. Talk to Belsky about that in a minute because he owns it. Kinder Morgan and the Williams companies.
Yeah, so Kinder Morgan and the Williams companies, let's start with those. Those are lower beta. These are midstream firms. They're not as sensitive to the price of crude, and they're really more pass-through of income vehicles. The ones that are sensitive to the price of crude that are on my best stocks list, EQT is up 27% year to date. Expand EXE is up 19%. Doesn't sound crazy until you consider the rest of the sector is flat to down. So these are the best stocks in the market in the oil segment. They've both obviously reacted well to the fact that WTI crude entered the month of June at $60 a barrel. It's up substantially from that level, remaining elevated. I have no edge on geopolitics. I don't know if we're doing a bunker buster or if Iran's going to surrender, or I have no idea. I'm just telling you, most of the stocks are not in my best stocks list, but I think the longer we see WTI crude in the 70s, the more of those stocks start to join the list because you'll see buyers come into them looking for opportunity. So I would be very alert in the oil names right now for the next leg of this rally.
How about that, Brian? I mentioned you own EXE.
Yeah, we've owned it for about a year. We like the stock because it's primarily natural gas, and we've been worrying about WTI for a while. And remember, when WTI is negative on a year-over-year basis, it typically portends to the sector underperforming. Now, obviously, we have geopolitical events that are driving energy stocks higher, but I think EXE, which is a combination of the former Chesapeake and Southwestern, has a lot of play in terms of a pure play with respect to natural gas.
Yeah. Shan, what about energy here?
It's the most undervalued sector in the S&P 500. And to Brian's point, I mean, you don't necessarily have to love oil. You can just really like natural gas, which is where a lot of this electrification and transformation is coming from.
Diamondback and SLB, still your best?
I would love to just trim SLB. It's up 13% from its lows. It is very cheap, but lower oil prices means lower activity. And I know we've seen a bounce in crude, but it's still down 22% from 2 years ago.
All right. We'll do finals after this.
following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Josh Brown, your final trade is what?
Oh, so I'm just changing mine now. I actually want to lead with IEO. These are the energy stocks that I think have the best potential to break out from here. The whole space, it's ready to go.
All right, so CrowdStrike's the substitution. You get
yeah, that's working, but yeah.
All right, Belsky.
Southern Company, SO play on traditional utilities.
Southern Comfort, is that what you said?
Southern Company.
Oh,
well,
company.
I mean, I could use some Southern Comfort, let's be honest.
I thought you had SoCo on the brain. So, Shan?
Materials benefit from inflation, but also an inflection higher in economic and industrial activity.
All right, Steph.
Uber, it's down 10%, industry leader, dominant market share.
All right, we're going to watch this market, see if we can get out of the red. Dow's down about 140 as it looks. There's the S&P about 0.5%. The exchange begins right now.
Thank you very much, Scott, and welcome to The Exchange. I'm Kelly Evans. The debt bill's at a standstill. Tariffs may not be inflationary, and home prices are falling. All of that is coming up this hour. Stocks are lower today as the conflict between Israel and Iran enters day 5. As you just heard, we're down about 1/3% on the Dow, about 0.5%, a little more for the NASDAQ, 440 on the 10-year yield. President Trump writing moments ago, they know where Iran's supreme leader is hiding. but are not going to take him out for now. The president also demanding, quote, unconditional surrender. Amid all that, retail sales this morning coming in weaker than expected, down almost 1% on a pullback in auto sales, biggest decrease since January. And the Senate's budget bill seeing significant pushback from GOP members, making its passage by July 4th increasingly unlikely. And that's where we begin this hour with Megan Casella up at the G7 with the latest as the president left before the key trade and tariff talks today. Emily Wilkins has the latest on that budget bill, and strategist Dan Clifton is here with what it all means for markets. Welcome to all of you. And Megan, what's the latest?
Kelly, that surprise departure of the president from here late last night, that's by far the biggest moment coming out of the G7 so far. The White House canceling today's plans, including some bilateral meetings, in order to get back to Washington to focus on the Middle East. And as you just mentioned, just in the last few moments, we've heard from the president a significant escalation of his commentary towards Iran that raises really serious questions here about the level of the U.S.'s involvement at this point. He said in a Truth Social post, "We know exactly where the so-called supreme leader is hiding. He's an easy target, but is safe there. As you said, we are not going to take him out for now, at least not for now, but our patience is wearing thin." Kelly, that post came just a few moments after a previous one where he said, "We now have complete and total control of the skies over Iran." He went on to later say in that post, "Nobody does it better than the good old USA." Kelly, both of these coming as the major question today has been whether and how far the U.S. is willing to go to facilitate the Israelis as they continue these talks against Iran. It's playing out in public now in a truly remarkable way, in a way that we really have not seen before. As for the G7, Treasury Secretary Scott Bessent is still here holding meetings, leading the U.S. delegation. So maybe we'll see more on that trade front that you mentioned. But back in Washington, the president is set to be in the Situation Room holding a meeting with his national security team. We expect that to get underway momentarily.
Megan, do you think it's fair to say that the expectation was today's talks, if the president were still at the G7, could center more around getting some of these tariff deals done before the timeline is up in a couple of weeks? With him leaving, is there any realistic expectation that these deals are going to happen now?
At least not anytime soon. The idea was really to get deals here. Both the White House and the other countries wanted that. One of the bilaterals set for today was with Mexico. President Claudia Sheinbaum, Mexico not a member of the G7, but was an extra invited guest. So we know they were pushing for a deal. The president also met, we think, with most of the G7 members yesterday, as well as with the leaders of the EU. The only one not confirmed to have a one-on-one was Italy's Meloni. But it's possible that those were the early meetings. There could have been further going on today on the trade front. Yes, Bessent could be here to continue those negotiations, but as all of these leaders know, with this White House, what matters most is talking directly to the president, Kelly. So without him here, we just don't know what's going to happen before this deadline, especially with so much now in the Middle East, just after so much was going on with China, right. Both of those potentially requiring a delay in the deadline.
A lot of balls in the air at once. Megan, appreciate it for now. Thanks. Megan Casella. Back in Washington, the president's mega bill is facing an uphill battle through Congress. Emily Wilkins has the latest. Emily, amid a revolt that's already taking shape, it seems.
Kelly, yeah, and this is again coming from multiple sides, multiple members, lots of concerns. This is on that Senate tax bill that just dropped yesterday. It's already running into that opposition. So let's break it down a little bit. You have some senators who are concerned about Medicaid. You have Senator Josh Hawley. He's worried about the current cuts. You've had a number of other senators who have said they're just afraid that the Senate bill goes a little bit too far with some of those provider taxes that states levy on healthcare and trying to limit those taxes. Then you've got senators like Ron Johnson from Wisconsin. He said that he has a lot of concerns when it comes to the overall cost of the bill, and he's worried that they are missing a chance to really make some cuts in favor of just focusing on what can pass the narrow majorities. Listen to what he said this morning on Squawk Box.
They talked about the only numbers that count are 218 and 51. Again, that's not the type of goal setting we need when we're $37 trillion in debt on the road.
And then, of course, you've got that state and local cap, that a deduction cap that's reared its head once again in the Senate. The Senate is saying that they're likely going to have less than what the House passed, that $40,000 cap. That has gotten immediate pushback from House Republicans from high tax states, saying that if the Senate passes a bill that does not have that cap, that has even $1 less, that it's dead on arrival in the House. And then other House members, a number of fiscal hawks that really fought to make sure that they were curtailing a lot of those green energy tax credits
candidates that passed under Biden are now frustrated to see that the Senate bill extends the phase out a little bit. So it slows down the phase out. It gives some of these industries a little more time to get those credits. You saw Congressman Chip Roy the other day tweet, "Yeah, I will not vote for this," referring to the Senate bill and to those green energy tax credit provisions. And Kelly, as you mentioned, Senate Majority Leader John Thune, he was hoping to have the bill on the floor maybe as soon as next week and be able to pass it by July 4th. But at that point, it's looking very rocky whether that's going to happen. A couple senators have already told us that they believe that they might go past that July 4th deadline. Kelly?
So a lot of losers here. We see the solar stocks under pressure today, among many other areas of anger. Who are the winners? Who actually comes out of this, getting more of what they want? Or is the whole idea that the price tag is lower and that would be the real win?
Oh, Kelly, there are definitely some winners here. The business community has been very happy today, I think. A couple of their provisions that they were really fighting for, some of the basic tax breaks, they are getting extended now permanently under the Senate plan. And some of the concerns about the revenge tax that was worried with some foreign investors and multinational companies, that hasn't completely gone away, but it has been softened a little bit. And then, of course, private foundations, they were facing a tax under the House bill. The Senate has now completely removed that. And there will be millions of Americans who will see their taxes. Basically, there was going to be a spike at the end of 2025 with the 2017 bill expiring, and the Senate really keeps a lot of those provisions in place and going forward so that Americans aren't going to see a tax increase at the start of 2026.
Right.
But still a long way to go for this bill. We're going to have to see exactly what the Senate passes and then how it's received in the House.
All right, Emily, for now, thanks. Appreciate it very much. Emily Wilkins. When it comes to the bill, our next guest says time is of the essence, especially with the economy hanging in the balance. Let's bring in Dan Clifton. He's head of Washington policy research at Strategas. Dan, welcome. First of all, does the price tag of the Senate bill come down? Do we know yet?
Well, it's going to be roughly in line with what the House bill is going to be, but the allocation, Kelly, will change. What this bill does is it makes all the business tax cuts permanent, but it actually gets rid of some of the short-term stimulus for the consumer. Higher child tax credit reduces no small business deduction at a higher rate of 23%. So what you'll see is a more level type of budget deficit over 10 years. But overall, the price tag won't be meaningfully different than what the House bill was. So they're consistent in that respect, but they take very different approaches here, Kelly. The House bill tried to do what I call a field of dreams bill. Build it and they will come. They put a lot of different provisions in there to get there. And what the Senate bill released last night does, it says, what was the Tax Cuts and Jobs Act in 2017? Let's take all of those provisions, make them permanent. We'll throw all the other stuff out, and then we'll pay for it with some of these other cuts. And I would look at that Senate bill as a baseline. It will change. It will change in committee next week when it goes up in committee. It will likely change on the floor through the Senate amendment and budget vote-a-rama process. So it's going to get modified. But our big concern is now that you've started this process over, the economy is slowing here, the debt ceiling is looming, you don't really have a lot of time to start this process over. And you want to get this bill passed so you could sterilize those tariffs that are already being enacted and really being paid for. And we can see that in the Treasury data every day.
Right. Many see this as kind of a little stimulus piece for the economy, which as the consumer reacts to tariffs. Speaking of which, on that front, a couple of weeks to go until the tariffs are potentially going back up to those Liberation Day levels.
Yeah. So if you look at what's going on, I wasn't really of the belief that Trump was going to get a lot of deals at the G7, but it creates the opportunity for deal making, and the president loves making those negotiations. So in our view, we were setting up a stage for an agreement to have future agreements down the road. And my sense is that we're just probably going to build more roadway here, just extend out some of the July 9th for some countries. Another option is that some of the rates go up a little bit, right? They don't go all the way up to their April 2nd level that the president proposed. But if you're negotiating in good faith, the level goes up a little bit and you continue to negotiate. But what the president is asking for is what are called rules of origin requirements. Those rule of origin requirements say to get a lower tariff rate, the product can't be made so much in China. Mexico and Canada have those rule of origin requirements in place. Other countries do not. So if countries don't agree to that, interestingly, Mexico and Canada are going to be the big winners here because the other countries will get higher tariff rates and the onshoring will then move into Mexico and maybe even parts of the U.S. and Canada.
Which, for what it's worth, was some of our guests' predictions back in January, February, that this would ultimately be about kind of talking tough with Mexico and China or Canada before bringing them to the table with a stronger North America than vis-a-vis the rest of the world. All of that to the side, Dan, what do you make of the president's latest comments about Iran and the direction that that's going as these two other major questions hang in the air about the budget bill and tariff policy?
Yeah, I'm still very much of the belief that the president doesn't like war, that he wants peace, and he wants to get this resolved. But if you look at the comments that have been made throughout today, it feels as if the scales are tipping to him actually joining with Israel when he's using the word we and when he's doing other factors of arguing that we have control of the skies or complete surrender. So it feels like the balance is tipping here and it's moving in that direction. It could be a negotiating strategy. But when you start saying get out of Tehran, last week they were saying get out of the embassies and eventually attack came. We have to take the rhetoric pretty seriously here that it's moving in this type of direction. So from that perspective, I think it's getting a lot more serious, and we can talk about a tax bill, we can talk about trade, but it feels like this is going to be the big issue, Iran-Israel, over financial markets, over the energy markets, and of course, by nature, over the equity market.
Does it have last question, a political impact when you see the rift within the GOP on this? Obviously, there's a rift over what to do with the bill as well.
Yeah, well, look, there is going to be a rift in the GOP over this, but I would argue the media have been reserved, the Democrats have been reserved, world leaders have been reserved. There hasn't been a lot of pushback on the president. And there are a lot of people in the media establishment who usually criticize the president who are looking for regime change. So it's a different path that I've seen with Trump being president, where he's being given some leeway from all the different stakeholders on this. And I think what's interesting about the inner GOP fight that's happening is that the president's standing up and saying, I'm the America First president. I get to determine what America First president is. He's directly taking on his base when he says that. Another indication of where he's tipping in terms of what side he's choosing to come on. And that decision could be made today, Kelly, a very important decision, most important of his presidencies.
Interesting. Dan, for now, thanks. We appreciate it. We'll leave it right there. Dan Clifton of
Kelly.
Strategas joining us. And coming up, we're also about 24 hours until the Fed's next decision on interest rates. They're meeting as we speak. We'll tell you what Wall Street's top money managers and economists are expecting about tariffs and their impact on the Fed's path forward. Plus, our market guest warning of a pullback during the upcoming earnings season. Why and why he says the Fed is likely to fall further behind the curve. It's all ahead on The Exchange.
This is The Exchange on CNBC.
5100.
Welcome back to the exchange. We're about 24 hours away from the Fed's next rate move, and tariffs are still on everyone's mind, especially their impact on inflation. Steve Leisman has a couple of takeaways from us from the latest Wall Street CNBC Fed survey. And Steve, what did we find?
We found, Kelly, that most respondents forecast that price increases from tariffs are coming. But the good news may be that some think they will be just a one-shot deal when it comes to inflation. Take a look at the data here. A slim 43% probability say tariffs will result in just a one-time price increase. 32%, however, worry it will lead to a broader inflation problem for the Fed. 11%, they don't see a significant change. And 14%, they're the honest ones. They say they don't know. Forget the recent benign inflation report. 61% chime in that tariffs will show up in future months more significantly, while 36% look for them to have only a modest impact on prices in the months ahead. Tariff uncertainty remains high among 71% of our respondents who answered very or somewhat uncertain on the outlook for tariff policy. That is down, however, from 87% in May, still elevated, though. Economist Joel Nareff writes in, while it appears that the worst case scenario when it comes to tariffs will not happen, the best case scenario still implies significantly higher tariffs and therefore higher inflation for an extended period. But 54% do expect a new trade deal with China. 39% do not. Those who think a deal is coming, they see it happening in an average of about 5 months. The timing and magnitude of the tariff impact, well, that's going to be key to the Fed outlook, obviously. And a majority believe the Fed will be confident enough in inflation or worried enough about the economy and employment to cut in September, Kelly.
All right, so still looking maybe for them to lower rates in a few more months. Steve, stay right there as we bring in Paul McCulley, PIMCO's former chief economist. Paul, always like to speak with you on the eve of these decisions. And so far, the preponderance of evidence has kind of been to the deflationary side of the tariff case. I mean, even, let's see, apparel prices slightly lower. There's not a lot in any of the reports up until now that point towards a lot of price hikes throughout the economy. I guess, Paul, we'll have to just see what the next couple of months bring.
I think that's right. But the bottom line is the most recent data has not been stagflationary, but actually a continuation of a soft landing. And I think that is very good news. Now, I think I agree with the consensus from Steve's survey that the tariffs will have a stagflationary impulse. And that it will be delayed because it's in goods and we're working off the non-tariff good inventories now. But fundamentally, I think that the economy was in a really good place to take the stagflationary shock. And the Fed was in a really good place at the restrictive side. So I don't think we should get too wrapped around the axle of negativity right now. I think we will absorb this.
Steve, jump in here.
Well, I will say there was some evidence of tariffs in the recent inflation reports. For example, you had appliances up. There were a bunch of commodity goods that did indeed go up. The import price data from this morning does suggest that the exporters are not absorbing it. And plus, Kelly, you did have $70 billion of tariffs collected. Somebody paid that. I think the story might be that you did have some disinflation in other parts of the economy. And now, of course, one of the worries might be what happens with oil prices in that they're not going down anymore. They may not be offsetting it. I think the idea, I like this 4-3 outlook on whether or not these tariffs end up being something that's a one-off thing or end up being something that causes a broader inflation. It's a good division there. I don't think anybody has the gospel on that particular answer, Kelly. And so I think that is more and more reason for the Fed to wait and see, despite the pressure from the president to cut. I think the Fed wants to be very careful that it's not cutting into a bigger inflation problem.
Right, understood. But Paul, are they being too careful? Because it's like, they say, well, we're erring on the side of caution by not doing anything. Well, but by not doing anything, that's still kind of a pretty big move, for lack of a better word.
They're being cautious, but I think righteously so. And I think the downside is pretty small of them being in this wait and see, because if the data start coming in very clearly that stagnation or worse is dominating the landscape, the financial markets will price in easing long before the Fed actually delivers it. So I think the Fed has an insurance policy against this charge of being behind the curve. By definition, they will be behind the curve when they operate with forward guidance telling you what their reaction function is. And then when the data come in saying by their reaction function, they should be easing, the markets will very vigorously front run it and ease financial conditions and therefore provide support to aggregate demand in the economy. So I think we should be really, really careful about this charge of behind the curve, because you have a release valve on that. Is they're so incredibly transparent that essentially they give the market the freedom to effectively righteously front run them.
Yeah, or I feel like, yeah, they're always behind the curve. We just don't know in which direction yet. Steve,
Kelly,
go ahead.
I would just add it's a lot easier, and Macaulay may know something about this, a lot easier to tip the cow when they're standing on one leg rather than all four. And the reason I say that is the Fed does not want to be leaning against where the long end of the bond market wants to go. The Fed wants to be able to tip that cow in the direction that it wants for the economy. But if it's got all four legs on the ground, and maybe a 440 10-year is not telling you right now that the bond market is dying, craving, or otherwise leaning for a rate cut there. So the Fed wants to be very careful that it ends up cutting or moving in the direction that the long bond wants to go.
All right. As milquetoast a statement as possible, that is the forecast or advice, I guess we could say, from Paul McCulley. Gentlemen, thanks. Really appreciate it today. And our Steve Leisman. Also, don't miss a First on CNBC interview with Senator Elizabeth Warren ahead of that Fed decision tomorrow. That'll be right here on The Exchange at 1 p.m. Eastern. And still ahead, we're talking alliances and algorithms. Tensions between OpenAI and Microsoft are reportedly reaching a boiling point. They could even go to Washington. We'll see. We'll look at how big tech is walking this tightrope to court AI startups, but also to keep them close. Speaking of AI, Reddit popped 16% initially after they rolled out a couple of new AI-powered ad tools to help boost agencies' engagement. The shares are pairing their gains now. They're up about 6% today and down 18% since January, even as the company does its best to lean in to all the AI stuff. We're back with more of today's biggest movers next.
IBM.
Welcome back. The Dow and the S&P are back to session lows. Spent most of the day in the red. We're trying to recover somewhat, but of course we've seen some pretty cautionary headlines from the president in the past hour or so. That's certainly not helping. 10-year yield around 440. The Dow was briefly positive, by the way, this morning. We're down about 200 right now. Let's get over to Dom Chu with a closer look at the action, Dom.
We're going to start, Kelly, with the bad news first, and that's broadly speaking the biggest laggards in the market tied to solar power. Enphase and First Solar, the biggest decliners in the entire S&P after the Senate put forth its version of President Trump's tax and spending bill that cuts a number of renewable energy incentives, including a provision that would phase out solar and wind power tax incentives by the year 2028, while keeping in place things for nuclear, hydro, and geothermal power. Outside the S&P, names like Sunrun and SolarEdge also taking bigger hits alongside the Invesco Solar ETF, ticker TAN. Worst day, by the way, since November of last year. It's on pace for that right now. Now for the good news, at least for shareholders of Jabil, those shares are the best performers in the S&P, up by just about 10 to 11% after the contract maker of tech hardware reported better than expected quarterly profits and revenues and raised its full year forecast, thanks in part to continued strong demand from its cloud computing and data center customers. Jabil also announced a $500 million plan to expand its U.S. manufacturing capacity. And we're going to end with the not-so-friendly skies, at least not for today. JetBlue shares are the epicenter of the downside action after CEO Joanna Garrity issued a memo to staff saying that the airline will implement a new round of cost-cutting measures due to softer-than-expected travel demand, adding that reaching break-even levels for operating margins this year is, quote, unlikely. Shares of other major U.S. airlines like Delta, United, Alaska, American, all down in sympathy with the move, Kelly. So keep an eye on those airline stocks. I'll send things back over to you.
Tough stretch for them. Add in higher fuel prices. You got down price action, Dom. Thanks. To Courtney Reagan now for the CNBC News Update. Hi, Courtney.
Hi, Kelly. As the conflict between Israel and Iran rages, the U.S. is moving more fighter aircraft to the Middle East, as well as extending the deployment of other warplanes. Reuters reporting the F-16 and F-35 fighter jets are included in the deployment, which U.S. officials stress are for defensive purposes. Ukraine has called for an emergency UN Security Council meeting. The country's UN ambassador telling a state-run media outlet today that he requested a meeting in response to Russia's escalation of strikes on Kyiv and other cities. A Russian missile and drone strike overnight killed at least 15 people and injured 156 more in the deadliest attack on the capital this year. And Elon Musk's X is suing the state of New York to block a state content moderation law. In a complaint filed today, the company said the state's law subjects it to lawsuits and potentially large fines unless it discloses, quote, highly sensitive and controversial speech protected under the First Amendment. The Office of New York Attorney General Letitia James, who is named in the lawsuit, or New York Attorney, I should say, has yet to comment. Kelly, back to you.
All right, Courtney, thank you very much. Coming up, will tariffs actually cause the Fed to be behind the curve, not because of inflation, but because of deflation? One strategist says yes, and he sees a path to 4 rate cuts this year. Plus, we'll look at the future of housing. Will we soon be saying goodbye to hammer and nails and hello to software? The XHB ETF coming off a 4-month losing streak with more negative data this morning. That's still ahead on the exchange.
minimums.
Welcome back. And stocks are lower today after the disappointing retail sales number and as investors digest the latest developments in the Middle East. My next guest warns it might not even be geopolitics or the hard data that will be the next hurdle for stocks. Could be earnings season. Joining me now is Ironside Macroeconomics Director of Research, Barry Knapp. And it's great to have you here on set. Welcome.
Fun to be here.
So many things. I mean, how are you discounting all of these disparate events from the Middle East drama to the tariff fight that could be back on the front burner in a couple of weeks' time and everything else going on?
Well, if we start with trade policy, since that's been foremost in the market's mind for the last couple of months, I think the clear message from the markets in April was the impact on final demand and aggregate demand was likely to be much greater than it was ever going to create some persistent price effect. Right. We had a deep inversion of the 2s, 10s break-even curve, meaning and the same thing happened in April 2022. The idea was if there was any inflation, it was likely to be transitory. But we know what happened to the equity market during April. And so the markets were pretty clear that this was going to be a bigger hit to demand than it would ever, as I said, create an inflationary shock.
At the same time was when I had that dinner with all the supply chain execs, and every single person at that table said the odds of a recession this year were upwards of 90%.
Yeah, well, that was part of the idea, was this would create a big hit to demand. But listen, as you well know, inflation is always and everywhere a fiscal and monetary phenomenon. So let me just leave a couple of stats for the audience.
People don't seem to believe that anymore, by the way. Even though that we've just run this incredible experiment, this natural experiment, said, yeah, no, that is what it is, actually.
Right. So here's just some simple numbers for people to have in their head. M2 growth on an annualized basis is 4.5%. The average since 1960, when they started calculating it, is 6.7%. In early 21, it was 26.7%. So the monetary conditions are decided, almost the antithesis of what they were in 21. Government spending as a percent of GDP, as Friedman said, don't tell me about the deficit, tell me about government spending. That was 29.75% of GDP in 2021. It's down to 23.4. I've argued all along it needs to get back to 20.3 to ultimately, really create lower inflation over time. But it's 6+ points below where it was in 2021. So the conditions don't exist to be able to pass prices through. And we see that in the retail sales numbers, which
I totally agree. And by the way, I think we've seen that in the marketing from the last couple of months. You've seen automakers and different groups, Verizon telling consumers, don't worry, we're not going to pass this along. In fact, we're going to offer you price discounts and during this difficult time.
I heard Steve say earlier today, were it not for this tariff uncertainty, the Fed would be cutting rates. Sure, they'd be cutting rates. CPI on a 3-month annualized basis is 1%. Wow. Core is 1.7%. It's missed, CPI, PPI missed 4 months in a row. So we've got, I think there's 4 schools of thought on inflation. There's, Adam Posen, who you had me on with not too long ago, is telling you, okay, it hasn't hit yet, and it's going to create a persistent effect. Then you've got it just hasn't hit yet. Then you've got we've resumed disinflation despite tariffs. And then you've got my school of thought, which is, no, tariffs are actually impairing demand.
They're more disinflationary.
And so it's actually exacerbating that disinflationary effect. It's a
like
bigger risk. It is a tax hike. Exactly the issue. You tax import something, you get less of it. You're taxing imports. You're impairing growth. There's fewer dollars in circulation than there was.
Here's the only problem. Intellectually, I agree with you on all of that. And yet we look at GDP, we look at the market, and that seems to be coming out of a playbook of more of what Paul McCulley just described, of this kind of soft landing, of this idea that, final demand is actually surprisingly resilient.
Well, I think that's, of course, you have to look at the whole policy mosaic, right? And so one of the things you and I were talking about a little earlier was an underappreciated aspect of what's happened this week with the Senate's version of the big, beautiful Bill Act.
OB3.
Is making those tax incentives permanent. So when TCJA was passed in 2017 for early 2018, capital spending took off. Now, it went on in structures only for about 6 months because the trade war derailed the positive business confidence shock. But in this case, we took the shock up front. And so now if you make expensing equipment permanent, you make more attractive expensing taxation for factory investment, and you have favorable R&D treatment, we had the weakest CapEx cycle since World War II, other than 58 when Ayn Rand published Atlas Shrugged last business cycle. So we are on the verge, I think, of a real capital spending boom.
Wait, so do we, if we're already on the verge of a capital spending boom, do we need the more business-friendly provisions that the Senate just put in the bill?
That's the final step. For me, that was the final step, is to make this a more attractive destination for capital. And yeah, we probably do need a little bit of impetus around this. They're not going to cost anything over time anyway. I mean, the history of receipts as a percentage of GDP is you do supply side tax reform, receipts fall for a year, and then they go right back to 17.1%. My favorite stat is, since World War II, receipts have averaged 17.1% of GDP. The standard deviation by each 4-year presidential term is only 0.8%. So change tax policy all around, you come right back to 17%. That's what you collect. So the reason why industrials are doing so well is this idea that we're going to broaden the CapEx beyond just Gen AI, and we're going to have a real strong capital spending cycle that boosts productivity over time.
That becomes then why the economy and why the market is holding in there. So
this is Besant's detox, right? I wrote the week before he said that, I wrote cleaning up the industrial policy mess. And my idea was moving away from Janet Yellen's modern supply side.
Is catchier.
Right, moving away from supply side or modern supply side industrial policy to spurring private sector capital.
Quick final question just to bring this back around, because it actually sounds like a fairly positive story that you're telling here, but you also warned a little bit about earnings season and what we might be about to go through. So what does all of this point to us? And not to ask you for an S&P price target or whatever, but kind of what's the earnings risk, and then how does this all shake out in terms of where the market should be priced right now?
Sure. Well, to answer the second question first, I was an equity strategist, as you well know, at Barclays, and so I had a 10% forecast at the beginning of the year. I did not ever cut that.
Okay.
I thought that we still had a good chance to get there, and I still think so. 6,600 or so is totally reasonable. But earnings season could be tricky because in the import prices today, we saw Chinese import prices are falling. So we suspect that part of the tariffs are being absorbed by exporters, but probably part of them are being absorbed by importers as well, particularly small businesses, which is why we need the Fed to be lowering that policy rate. So we're still having this underlying struggle, and we're going to find out during earnings season just where that margin story is falling out.
That's a great point.
That could
But
be
you think we get through
a
it?
pullback, and then that's probably a very viable pullback because the CapEx numbers probably really start to improve in the second half.
Where else do you get this kind of detail? It's like I said earlier, it's like a tapestry, just like your jacket. It's like a tapestry, Barry.
Ashish Shah once called me the Rain Man of economics, my old colleague who's now at Goldman.
Yes,
So,
yeah.
this stuff just sticks in my head. But anyway.
Well, thank you for raining it down on us. Barry Knapp of Ironside's Macroeconomics. Coming up, tensions are flaring between Microsoft and OpenAI, with OpenAI's for-profit conversion the dividing issue. What's next for the partnership and why it matters more than the latest algorithm or anything else going on? That's next.
now.
One of the biggest partnerships in AI could be reaching a breaking point. OpenAI reportedly growing frustrated with its obligations to Microsoft. Deirdre Bosa has a closer look in today's Tech Check. Hi, Deirdre.
Hey, Kelly. So this was once the AI partnership, widely seen as the most strategic, the most well-aligned in the industry. Microsoft brought the capital and the data centers. OpenAI brought the talent and the breakthroughs. But now they're both diversifying, and increasingly they're competing with one another as well. Microsoft is building its own models, even featured Elon Musk at its developer conference, a signal that it is open to new model partnerships. OpenAI, meanwhile, is working with Oracle and reportedly Google, pushing for multi-cloud access and moving deeper into enterprise and defense. Now, it's also raising tens of billions of dollars more as it tries to convert it to a for-profit company. That is a move, Kelly, that would give it greater control over its future, but would also squeeze Microsoft's stake and strategic leverage in the process. So what it all comes down to at the center of it all is AGI. That's artificial general intelligence. The idea that a model could match or even exceed human level intelligence across a wide range of tasks. This has been part of the Microsoft OpenAI contract since the very beginning. When Microsoft invested $1 billion in 2019, there's a clause that says that once OpenAI declares AGI, the partnership ends. So it may be no coincidence that Sam Altman keeps bringing it up. He has publicly said that GPT-5 could approach AGI, and he's been openly debating what should count as AGI. For Microsoft and its investors, that could be a huge risk. If OpenAI makes that declaration too early, it could unravel its more than $13 billion bet too late, and it could miss the window. OpenAI could miss the window to raise more capital and let rivals beat them. So, Kelly, these are hugely consequential cracks that are showing, and I'm quite certain we haven't heard the last of it.
No, it goes back to, it reminds me a little bit of what happened in the media world when Disney and Comcast and the others, all JV'd on Hulu, and then it was a very messy breakup, and this could be very much the same kind of thing.
Yeah, good analogy. And I think that it's really important now to read the tea leaves and look at who's talking about AGI. I mentioned Sam Altman. He's been talking about it increasingly this year. Masayoshi Son as well at SoftBank, who OpenAI and Sam Altman have sort of turned to. So at the same time, we're seeing these cracks between Microsoft and OpenAI, one of the sturdiest partnerships in AI. We're seeing new alliances and new realignment taking shape.
Yeah, that is one to watch. Deirdre, thanks very much. Appreciate it today. Deirdre Bosa. Coming up, June's homebuilder sentiment coming in near pandemic lows on the heels of Lennar's soft guidance. It's weighing on the builder stocks today, and we'll get more detail on that next.
Centers.
Welcome back. As the market moves to new session lows, we're still talking about declines between half of, not quite 1% for the NASDAQ, but we're definitely keeping an eye on it. 10-year yield slipping below 440, so a bit of a flight to safety feel right now. Homebuilder sentiment posted a surprise drop this morning as higher rates and ongoing uncertainty do weigh on activity. Let's get the latest from Diana Olick. Diana, on a report that is one of basically the worst we've really had in the last couple of decades.
Yeah, it's pretty bad. Yeah, Kelly. Sentiment in June dropped from May. The street was actually expecting a slight improvement, probably because of some tariff delays and negotiations and the stronger stock market. But this really shows it's a bigger consumer problem. The index is now so low that the only other time since the Great Recession that it's been lower was in April of 2020 when the pandemic shutdown hit, and then at the end of 2022 after the Fed started raising rates from those record lows. Now, all of the index components, that is current sales conditions, sales expectations over the next 6 months, and buyer traffic dropped. The last one was down the most. This goes along with Lennar's quarterly earnings, which we got yesterday. They were mixed, but guidance was lower than expected, and the average home price was down nearly 9% from a year ago. On the conference call this morning, Chairman Stuart Miller was clear.
The macroeconomy remains challenging as mortgage interest rates have remained higher, while consumer confidence has been challenged by a wide range of uncertainties, both domestic and global. Across the housing landscape, actionable demand has been diminished by both affordability and consumer confidence.
37% of builders in the NAHB June survey said they cut prices, which is the highest share since they started tracking this 3 years ago. It's up from 34% in May and 29% in April. The average price reduction was 5%. So, Kelly, it's not getting any better.
By the way, that is becoming more of a theme. Price reductions in that survey. Lennar talked about prices being down, was it 9% year on year?
Right, 9%. And it's interesting because we've been talking so much about mortgage rate buy downs, and they're actually talking now that it's harder to do that because even at the lower rates, buyers just aren't qualifying for those mortgages. That's because of credit, bad credit.
That is a point. It's not going to help change that picture. Diana, for now, appreciate it. Thank you, Diana Olick. So where does the industry go from here amid a mixed economic picture and no near-term resolution on these tariff pressures? Let's ask John Lovallo. He's U.S. home building analyst at UBS here with me on set, which I appreciate. It's good to see you.
Good to see you.
I mean, the number this morning was awful. It was absolutely awful. And the builders had enjoyed a little bit of a period of outperformance because of these buy downs and so forth. Now that doesn't seem to be working as well.
It's not dead. So we're not quite as negative as Diana might be. What I would tell you is that, look, first of all, the sentiment index is a gauge of mostly private builders. So it's certainly skewed towards smaller builders that are having trouble getting access to land, labor, materials, capital. But don't get me wrong. I mean, the market's not good, right? Demand is soft. Interest rates are high.
Yeah.
Tariff uncertainty. Consumer confidence is not great. So what we believe is happening is investors or buyers are kind of taking a pause. There's still the underlying demand is still fundamentally strong. It's just getting folks comfortable with the ability to get out there and actually transact.
Sure. So that being the case, what do you do with the stocks, which have been struggling for months now? And you could say maybe this is a window of opportunity. I don't know. But now we're seeing more headlines about price declines, and that's never a good thing, never something you want to see from that point of view.
No, but I would agree with the first thing you said. I think that the stocks are reflecting a tremendous amount of bad news. I mean, we're trading at close to book value for many of these builders, trading at 7 times earnings.
Wow.
These are forward-looking stocks, right? They sort of saw the slowing coming last summer and started fading even when the market was ripping. And now I think we're in a position where we could very quickly see that kind of move upwards here before we even hit bottom.
I remember back to 2022-ish levels whatever the year was, I believe when rates first started spiking, those multiples fell to like 4 times in some cases. It was almost a historic buying opportunity, but now we're starting to become in a similar territory.
We are, and I would also say the stocks and the companies are very different. I don't think we'll see those multiples again. These are land light, cash generative companies that are not throwing every dollar of cash flow back into land. They're paying dividends. They're buying back stock. they're really being good stewards of capital.
Yeah.
And so,
I mean, we're also possibly at an inflection point, a transformation point, really, for the industry. And you wrote about this recently that could change the whole way that homes are built. And there's pressure because of labor costs. There's pressure because of whatever's going to happen with the labor force there, period. Maybe you can comment on that.
Yeah.
So how do you expect this all now to look for the next kind of 5-10 years of home building?
Yeah, let me try to paint a picture here. The home building industry is building homes the same exact way they did 100 years ago, stick framing on site. Construction is the only major industry in the U.S. to have negative annual productivity on average since 1987. There's a worker shortage of 200 to 400,000 people. We're 7 million units underbuilt. And what does this all mean? Affordability is the worst it's been since the mid-1980s when rates were over 10%. So this industry is really in dire need of change. We believe offsite construction, and that's the report that you referenced, is one way to sort of revolutionize things. And we believe that we're moving in this direction.
Can I use the word factory, or is that not?
That can have a negative connotation.
Yeah, intentionally, meaning what is offsite?
Yeah, great question.
Building, and why is it so different?
Yeah, so there's many different forms. What we're talking about specifically in the report is wall panels. So building the actual walls in the confines of a manufacturing facility, weatherproof, for instance, et cetera. Roof trusses are very popular today. About 70% of homes use that. Only 15% of homes use wall panels. We believe that will go up to about 41% over the next 15 years. And what this means is that when you start building things in a factory setting, the precision is very tight. The tolerances are near aeronautical grade. You can build faster, you can build more homes, and at the end of the day, that can help affordability.
Well, I appreciate the kind of pointer about things to watch as we're all worried about what's going to happen with this industry. It's so critical for so many people. So then finally, what are your favorite stocks or anything you'd steer clear? I mean, just tactically speaking for people, what's the best way to position?
Yeah, so in terms of this report, I would say Builders First Source, which is a component manufacturer, about 50% of their products are these kind of value add products, is a very interesting way to play this theme. But we like the home builders a lot as well. Meritage Homes is our top pick there. We like D.R. Horton as well.
All right, John, appreciate it today. Thank you very much.
Thank
John Lovallo with UBS. And that's it for us. Thank you for watching The Exchange. As we look at the markets, again, under some pressure amid a lot of tension in the Middle East right now. It's got yields on the move as well to the downside. You can see it there, 439. I'll join Brian Sullivan for Power Lunch, and our coverage will pick up right after this quick break.
That was great.
Stocks and your money lower ahead of the Fed as the world watches Iran. Welcome to Power Lunch, everybody. Your money dominated by a number of headlines right now. First up, President Trump bailing on a meeting of world leaders in Canada. It's as the world watches and maybe readies for potential military action on Iran. All of that as the Federal Reserve kicks off a two-day meeting with an interest rate decision on deck. Kelly.
Let's begin with the latest developments in the Israel-Iran conflict. The president weighing in, posting on Truth Social and calling for nothing less than Iran's unconditional surrender. And stocks are at session lows right now. That's a bold statement that underscores just how high the geopolitical stakes have become, not just for the region. We're talking about global diplomacy and security here. And that's where we begin today.
Yeah, President Trump's latest comments. Megan Casella is in Canada, where the G7 has become the G6. Megan.
Brian, that's right. Meetings and programming have been continuing here today, but all of the focus has been on the ongoing conflict in the Middle East after the president's abrupt and surprise departure late last night. All of those discussions ratcheting up even more after the president just in the last hour or two posting on social media, escalating his commentary against the Iranians and, as you said, calling for unconditional surrender. In the first post, the president saying we know exactly where the so-called supreme leader is hiding, calling him an easy target, but saying we are not going to take him out, at least not for now. Our patience is wearing thin. In a separate post, the president also said we now have complete and total control of the skies over Iran. Guys, in both of those posts, note the use of the word we, really aligning the U.S. alongside Israel there closer than ever, raising even further questions about just how far the U.S. is willing to go to help Israel in these attacks and raising questions about what the next step is going to be from the White House in this ongoing conflict. All of this now playing out in public, really in a truly remarkable way, in a way we don't typically see for American foreign policy. But guys, there is also news still coming out of this G7, including one piece, Brian, that I thought would be of interest to you specifically. Earlier today, we heard from the EU Commission President, that's Ursula von der Leyen, and she said that now that oil prices are higher, that there's little pressure to lower that price cap on Russian oil. So that's one piece of the discussion that we thought we were going to be covering most of today. There's obviously a lot else going on, but it is something that impacts all of these discussions and all of the meetings that continue to take place. Guys.
Well, thank you for that. So to be clear, it appears that whatever news there was supposed to be around President Trump, the news now, the headline is that there is no President Trump. I think him leaving is the news, correct?
That's absolutely right. That is by far the biggest story to come out of this G7. And when the president was asked about leaving early, he said he had to be in Washington to focus on this conflict. It was easier to be there rather than have to rely on phone calls, I should say. And he also noted he felt like he had done what he had to do at the G7. I can say we confirmed that he did meet one-on-one with nearly every member of the G7, as well as the leaders of the European Union when he was here yesterday. The only question mark in that group is whether he met one-on-one with Italy's Giorgia Meloni. Everyone else he did have a side-by-side meeting with. So even though we didn't see a lot of the news we thought we could see this week on Russian sanctions, on trade deals specifically, he says he did what he had to do. Now the Middle Eastern conflict is what's taking all of his attention.
For sure. Megan, thanks for now. We appreciate it. Megan Casella. Let's talk more about that Middle East conflict and the impact of the president leaving the G7. Fred Kemp is president and CEO of the Atlantic Council and a CNBC contributor. Joining us from the Atlantic Council's Global Energy Forum, matter of fact, in Washington, D.C. And Fred, what's the buzz? What's the latest, especially amid the president's really sharp messaging on Iran just within the past hour or two?
Well, let's start with the G7. It says nothing good about the organization that the president leaves early at a time of geopolitical crisis. The G7 was created as a place where Western advanced industrial countries, democracies, talk to each other about just this kind of problem. And so maybe that's the reason he left, was he's a little frustrated with the group. That's also not a good sign if he's frustrated with a group that has always been a vehicle for the U.S. to do things. As for Iran, I think the White House is signaling pretty clearly to the supreme leader of Iran that you've got two choices. You can reach a deal that would put you in a position that you're really going to give up any hope of getting toward a nuclear weapon in the future, and that deal is on the table. or we can do it the easy way or the hard way. You'll continue to be hit by Israel in a military sense, and potentially by the United States. Let's remember that Fordo is what we're watching. This is the the deep nuclear installation in a mountain. It was secret for many years. Only U.S. weapons can take that out, B-2 bombers with 30,000 pound bomb. The Israelis can't really get to it, and we understand that's under some consideration. So the president is really seeing this moment as a time of key leverage on Iran. Their defenses are down, their proxies are down. They're unable to strike Israel in any successful way because Israel's defenses are up and working. And so this looks like a historic moment. You hate to put it this way, but sort of a do or die moment for Iran, where they really have to come to the negotiating table and reach a negotiation quicker, see things get even worse for themselves.
What is your position, Fred, or the Atlantic Council's position on how close Iran is to having a nuclear weapon?
Well, what experts tell me is they're days away from being able to assemble the fissile material that they would need to put together in a bomb. It then takes somewhat longer to turn it into a deliverable weapon with a system that can actually deliver it. So I think U.S. officials would say to actually deliver a weapon, it's more months away. The difference between the U.S. and Israel is Israel sees this as an existential question. If you can get Iran away from a weapon now and for as long as you can into the future, that means the survival of the Israeli state. For the U.S., it's not existential, but the U.S. has also said that they will never allow Iran to have a weapon. So even though we're looking at it from a different perspective than the Israelis, it sounds to me, as your reporter said, using the word we, that Israel and the U.S. are joined at the hip right now vis-a-vis Iran.
You know, how much of this, Fred, do you think is the national security threat around Iran? And how much of Trump leaving the G7 up there in the mountains of Western Canada is kind of a power play, a little bit of a flex where you're saying to your trading partners, Narendra Modi, Claudia Sheinbaum of Mexico, all traveling there literally to meet him. They can say what they want, but it's to meet Trump. Him leaving is a power play, and I wonder how much of that is just the power aspect of it and not the urgency of the moment.
Well, Brian, you seem to know our President of the United States very well. I think it's a bit of both. So trade is a tomorrow issue right now for President Trump. It's a today issue for those that traveled to meet him. Modi from India, Sheinbaum from Mexico, Ishiba from Japan. They all need to strike trade deals with the U.S. We're hearing that they may now come to Washington. The president feels he has until July 9th, which is the end of the pause. So that's all the time in the world for the president when he's got the Iran situation as a much more urgent matter right now. So yes, it's a power play on the one hand. I don't think he likes those kind of group meetings in any case, and he's putting his priority on Iran, and it's an urgent one for him.
Yeah, how does this play out? Where does this go in a week, a month, a year, Fred?
Well, I think I like your sentence. How does this play out? Because it is going to play out.
It has to. The current state is not sustainable.
There's a window to take care of what Iran's been doing, and there are four options, and I'm going to go through them really quickly. The one is they actually get their nuclear capability taken away from them through the power of a bombing campaign, and maybe even regime fall. The second is they reach a deal that takes away their nuclear capabilities, and those are the two relatively good options if you're looking at this as geopolitical. The less good options are they survive, they hang on to their bomb, they're even angrier at Israel, and we kind of back away from all of this. I don't think that's on the table right now. That's why I don't think things will be the same in a month or even in 2 weeks. I think this is a now moment, and of course, a very bad situation is absolute chaos on the streets of Iran and also
is this a moment? Do you think, Fred,
nuclear option in place?
I'm going to ask you to speculate. Obviously,
yeah.
Iran is kind of out there on its own. The Saudis they deal with them with OPEC, and Iran is the rotating president of OPEC this year. But the Iranians have always kind of looked to Russia for help. Russia's fully engaged with its war in Ukraine, its weekend. Is this the time of regime change in Tehran? The Iranian people are not to blame here. Just like China, it's their leaders, it's not them. Is there any chance at all the Ayatollahs are deposed and the Iranians sort of take back their country, for lack of a better term?
I think everything's on the table right now, Brian, and I think that is as well. I have a very close contact who's close to the Trump administration, and he's been in Iran in the past month. He knows Russia as well, and Soviet Union, former Soviet Union. He told me there's a perestroika feeling on the streets, and for those who don't know the perestroika period, that was a period of political reform in the Soviet Union. Economic reform was glasnost. All the repressive institutions were in place, but people had lost their fear, and those in charge of the repressive institutions weren't willing to crack down any longer. And he said that was the feeling on the streets, and that's the kind of feeling that came ahead of the Soviet regime collapse. But at the time, nobody was talking about Soviet collapse. So we are talking about that. Then does a monarchy follow it? Does a military state follow it? Does chaos follow it? I think these things are all on the table right now, and the region is very interested in those outcomes. The region wants, building on the Abraham Accords, a group of moderate, politically moderate, religiously tolerant, economic modernizing states like Saudi Arabia, like the UAE, like Oman, like Qatar, and that you bring the rest of the Middle East into this kind of modernizing, moderate, and that's the big opportunity that presents itself, because what stood in the way of that? It was Iran. And if Iran doesn't stand in the way of that any longer, you have a huge opportunity in the Middle East for quite a different alignment in the future.
Yeah. Well, hopefully we'll be speaking with the Iranians at OPEC in a couple of weeks. We're going to find out. Fred Kemp, thank you.
It's a great point.
History in motion.
Are you going to that meeting?
We hope.
In a couple of weeks?
I would hope to, yeah.
I mean, depending on what even happens with that meeting at this point. And as you said, Iran has the leadership.
Well, it's a seminar. It's like a conference. It's not. There's like a meeting around it, but there's also like CEOs that are going to be there.
Yeah.
But the fact that Iran has the rotating presidency is fascinating.
Yes, and the question about what they'll do now with this looming is one to ponder. For sure.
Diplomacy maybe through oil. We'll find out. All right. Let's get now more on oil and energy, because it's another layer to this growing story. We've talked about the importance of the Persian Gulf and the narrow Strait of Hormuz. Right now, oil and ships still flowing, but if something were to close it or impact ship traffic and oil and gas imports, you certainly could see a big spike in those prices. Remember, about 20% of the world's oil total flows through the region. So if shipping through there were to get disrupted, it becomes a global problem. And we just had a scary situation happen on the water. Overnight, 2 ships collided and caught fire. The old crude oil tanker Ada Lynn and another ship, the Front Eagle, smashed into each other in the Gulf. The Ada Lynn caught fire and burned. All the crew escaped safely, thank goodness. But there are many questions here. And as FreightWave notes, the Ada Lynn had no registered insurance, meaning it could be one of the so-called ghost fleet that we've been telling you about for a couple of years now. Let's talk about all of this. Joining us is Clay Siegel. He is Senior Fellow for Energy Security at the Center for Strategic and International Studies, also an analyst with extensive ship and tanker expertise as well. Listen, they jammed up, apparently, Clay, you tell me if I'm wrong, some of the signals on these ships, which pretty much operate like airplanes at this point, meaning it's kind of computers running the show. 2 ships colliding. It's happened before. It will happen again. But the timing is hard to miss at this point.
Hey, Brian and Kelly, it's good to be with you. You know, the timing is really auspicious because naturally people are concerned about ratcheting up tensions between Iran and Israel and potentially with the United States and even other players in the Persian Gulf area. And to your point, right, 85 oil tankers, something like 20 million barrels a day of oil, if you count crude and products, moving through the Strait of Hormuz, getting that oil to market. And it's all quite vulnerable. And apparently what happened yesterday with the collision was not a direct result of the fighting. It was related to a navigational error. But it's a heck of a coincidence that a lot of operators in that region were reporting what looked like jamming of navigation GPS signals at the very time that these tensions are ratcheting up, that people are worried about a rising risk profile for oil and gas shipping out of the region. So on a good day, we already have navigational problems. Oh, and then there's the added issue of one of them was apparently part of the shadow tanker fleet, which is being used around the world to try to evade sanctions. Those don't have the same spec as tankers in the legit market. So they're older, they're more prone to oil spills if there's a collision. They're often crewed by less competent personnel. So we need to worry about the confluence of these risk factors coming together in this very hot spot for global energy supplies.
And maybe we can show the intraday of WTI crude, which is up 4% right now, Clay. Obviously, people are a little bit nervous about what may be taking place with Iran at the moment. So can you talk a little bit down the road about this? I mean, what are some of the scenarios based on what the U.S. chooses to do or not do here? Bring it all back home to the price of oil and gasoline.
Sure. Well, traders are always evaluating the risk of a supply disruption in terms of how much volume could be taken off and how long it's liable to last. But I've spent most of my career looking at the probability of energy supply disruptions. And I have to tell you, if you told me Iran would be in what looks to lay eyes like a full-scale war, and we'd only be up to the mid-70s in terms of benchmark oil prices, at face value, I would be surprised. But, if you peel back the onions, it kind of makes sense. You guys are used to the market psychology of FOMO, but the prevailing sentiment in the oil market is, oh no, the oil halt never occurs. And I'm not sure that the traders are completely wrong with that sentiment. You've had years of Mideast upheaval with no material supply disruption, maybe a little bit in Libya from time to time, but not really in the Gulf. Demand is really slowing down around the world. We have a new indication from the International Energy Agency about that pattern today. Saudi Arabia and Iran, before this at least, getting along much better than in future years. And the most recent anecdote where we had a blow up, which was in 2022, when Russia launched its full invasion of Ukraine. As you know, we skyrocketed up to triple digit prices, $5 a gallon gasoline on the fear that Russian oil would be coming off the market. Turned out, relatively speaking, at least volumetrically, to be nothing.
I think what you're saying is there's plenty of oil in the world. And if this ends peacefully, and we all pray that it does, that maybe we'll see $45 or $50 oil because we won't have that geopolitical risk. If the risk premium has only taken us to 75 or whatever it is, Clay, not much of a risk premium. But how about this? Iran is a wounded animal, okay? And that means it's dangerous. It means it's dangerous. And if we have one mine laid in the Strait of Hormuz, one cruddy missile attack on some tanker, right? One of these tankers involved, by the way, was called the Front Eagle. It's based in Cyprus, but the company trades here in the United States. A company called Frontline, FRO is the ticker. No indication of any wrongdoing whatsoever. I want to make that very clear. But I don't want to say American flag. There are none, but kind of an American-ish vessel. If we have one mine laid, one ship sunk, what happens to the price of oil then?
Well, prices are going to move higher in that scenario, mainly because the cost of shipping is going to go up. Insurance, risk management, and even some players probably choosing to avoid the area, at least until things calm down, which of course is now the established multi-year pattern in the nearby Red Sea. And that has already affected oil and gas prices over the last few years. The thing to watch is the level of any supply disruption volumetrically and again on duration. If it's just Iran's oil going offline, it's about 1.5 million barrels per day. OPEC spare capacity north of 3 million barrels per day can cover it. There's some question about whether Saudi and UAE would immediately jump in to provide that coverage. That could be politically dicey. But if you get into an extreme scenario where major flows, I'm talking about flows from Saudi Arabia, UAE, Kuwait, others, are potentially throttled or cut off, there is no spare capacity that can be brought to bear to offset that kind of disruption. And the next ceiling for prices after that would be demand curtailment.
Yeah. Well, that's it. Watching those ships as hedge funds, they're watching live satellite feeds of not only how many ships are in the Persian Gulf, but the weight of those ships. In other words, how much oil is on them. If that changes, oil prices change. Clay Siegel of CSIS, thank you very much. We'll move on.
Thanks.
And again, crude is now up 4% on the session. So we are at session highs, just as stocks have recently and are now pretty much at session lows. Not extreme moves, but clearly a positioning here of much more caution. Coming up, everything you've just heard ties back to the major question of whether the U.S. is becoming more directly involved in the Middle East conflict. And the answer could depend on that secret mountain bunker in Iran we were just talking to Fred about. We'll have more details right after this.
Pumpkin.care. All right, whether or not the U.S. becomes directly involved in the Israel-Iran conflict could ultimately come down to one thing: a bunker. Get to know the name Fordo. That is the name of Iran's secretive nuclear site. It is their primary location for enriching nuclear fuel. It could be used to build a nuclear weapon. Now, the lab is built literally under or in a mountain, and it's believed that to hit it would require bombs and maybe airplanes that only the United States currently possesses. Let's talk about the defense side of the story. Morgan Brennan, of course, covers the industry for us, hosts the 4 p.m. show with John Fort, and joins us now. the bunker buster bomb, you heard Fred Kemp talk about at the top, and a B-2 bomber. If anybody wanted to go after this site, would it take direct U.S. help?
I think the bottom line is, as I understand it right now, yes, if you're going to employ this very specific type of bunker buster bomb. Keep in mind, there's a number of different types of these bombs. Israel possesses some of them, but the biggest, most powerful is the GBU-57 Massive Ordnance Penetrator. Yes, I know it's a nameful. You can call it MOP for short. Precision-guided 14-ton bomb can penetrate down 200 feet before actually detonating, not to be confused with the Moab for that reason, because it can penetrate. It's developed by Boeing in conjunction with the U.S. Air Force. Only U.S. B-2 stealth bombers are certified to operationally employ these MOPs, although they have been tested with B-52s in general. But either way, the bottom line here is you're talking about an American-made bomb for American uses that can only be delivered and deployed by an American-made aircraft. So to actually see this go to Iran and to this specific site, which is half a mile under a mountain, and be detonated would mean direct involvement from the U.S. Military and security officials basically saying to me now, both current and retired, that to see the U.S. become that directly involved, you're probably talking about Iran strikes or attacks on U.S. personnel or assets in the region for us to consider it.
Boeing is the one involved here in terms of its manufacturing.
Yes.
Interesting.
Yeah, that would seem, let's hope, a highly unlikely outcome. One would hope.
Highly unlikely, yes, one would hope. That being said, Israel has hinted that they have other ways of potentially getting to Fordo. And certainly there's been talk about, cutting power supplies, which is what we've seen at some of the other nuclear sites. Lots of questions around how all of that is going to play out.
Because I think what I was getting at, Morgan, sorry to interrupt, was that I was thinking, listen, using U.S. technology as an Iron Dome to shoot down their missiles is one thing. That's a defensive posture.
And Israel and the U.S.
right?
have both said that so far, U.S. involvement and ally involvement has been specifically that, defensive in nature.
Yeah, and using it in an offensive way, I think, is a whole different thing.
Yes, that directly brings the U.S. into this conflict. That being said, for investors out there who are tuning in and probably wondering, the fact that defense stocks have been trading higher or going back and forth the last couple of days in the midst of all of this conflict erupting and playing out in real time is Israel is very largely tied and dependent on the U.S. defense industrial base. So regardless of whether a MOP gets deployed or not, and hopefully it doesn't, you are still talking about replenishment of munitions and missiles and missile interceptors for, missile defense systems, aircraft sustainment with F-35s and F-15s, and you're still talking about all of the U.S. defense contractors that ultimately those orders, those foreign military sales are going to trickle back to. Israel has ordered something like $49 billion, according to Jeffrey, since 2013 in foreign military sales from the U.S., so that number will ratchet up.
Wow.
And also, the other piece of this, defense tech, AI, OpenAI got a $200 million contract yesterday. I'm not saying they're involved. I don't know. But what I will say is when you're talking about targeting and you're talking about massive data collection like we've never seen before from land, sea, air, space, as well with commercial space contractors who are in the mix here collecting data, what generative AI brings to the equation is rapid analysis of all of that data in a way that we've never seen before. So the Palantirs of the world, for example, are very much in play when you're talking about some of these strikes and some of the intel and President Trump coming out and basically saying, and I haven't spoken to Palantir about this, but there is such data now on the battlefield that didn't exist before when you talk about some of these comments about knowing where generals and the Ayatollah are, et cetera, et cetera.
Which blurs the line between defensive versus offensive involvement already, even before we talk about whether these particular bombs are going to be involved. So it's a great point.
And by the way, Russia is using Iranian drones to attack Ukraine. One wonder if Iran hopefully provides them with fewer drones.
This is the other
because
thing.
They need to keep them for themselves now.
Yes, and this is the other thing that investors need to understand here, which is that the mix of weapon systems is changing as well as more of this technology makes its way into the battlefield. It's something I did a big feature piece with the U.S. Army about. You can check out on CNBC.com because that mix is changing and it's going to make the budget that much more in focus.
Not the time for cuts, in other words. Yeah, Morgan Banks.
Or tune into Overtime, 4 p.m. Eastern Time with John Fort.
And Morgan Brennan.
And
I'm joking.
Who's that?
The housing sector is still showing some signs of weakness, but our next guest is betting on a turnaround. We have some names to watch in Market Navigator next.